at any time. As a reminder, I ask all members to keep themselves muted when they're not being recognized. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may only participate in one remote proceeding at a time. If you are participating today, please keep your cameras on, and if you choose to attend a different remote proceeding, please turn your camera off. I now recognize myself for 4 minutes to give an opening statement. Good afternoon and welcome back to the committee, Chair Gensler. You have a lot to restore and rebuild. During the Trump administration, the commission provided minimal oversight and eliminated key protections for investors. Trump's SEC enacted regulation best interests that brokers loved and investors hated. Trump's SEC approved proxy advisor and proxy access rules that corporate executives loved and shareholders roundly rejected. To favor multi-billion-dollar corporations, Trump's SEC did nothing to standardize reporting of environmental, social, and governance metrics. Even though the financial sector's growth exploded, the number of SEC staff under Trump was reduced by 5%, and enforcement actions against Wall Street fell to historic lows. And more troubling, working families and retirees whose hard-earned savings helped fuel the capital markets were ignored. There are only a few examples. The point is clear. Most of the policy and administrative decisions the commission made under Trump unsurprisingly favored Wall Street, large corporations, and their lobbyists. The SEC, under your leadership, also finds itself in the midst of a radically changing marketplace. Millions of new and often younger investors are entering the markets, but the rules of trading are stacked against them, providing larger established participants like hedge funds and others exclusive access to information and trading venues not available to everyone. In addition, the incredible growth of unregistered and volatile cryptocurrency assets, as well as the emergence of cryptocurrency intermediaries, market exchanges, and decentralized protocols, present your agency with historic challenges. Earlier this year, when the GameStop trading event raised significant questions about our markets, I convened a series of hearings to understand exactly what happened. We also passed several bills addressing some of our initial findings, including my bill, the Short Sale Transparency and Market Fairness Act, which provides our markets with greater and more timely transparency regarding the positions of Wall Street hedge funds and other large asset managers. We also marked up legislation related to gamification, payment for order flow, and legislation prohibiting market makers from trading ahead of their clients. I look forward to hearing an update from you about what the SEC is doing. And I'd like to make clear our investigation into the GameStop event is ongoing, and we will issue findings when our review is complete. As chairwoman, I expect the SEC will bolster the stability of our markets. However, I'm gravely concerned that the largest risk to the capital markets and the economy in the coming weeks is a train wreck we see coming. Republican members of Congress blocking the U.S. Treasury from paying its debts. We are now less than 2 weeks away, and my Republican colleagues are once again playing a dangerous game of chicken, even though fully 1/4 of the increase in the debt comes from Trump's tax scam, a $2 trillion unpaid tax cut for the wealthiest Americans and billion-dollar Wall Street firms. So I hope that you, Chairman Gensler, will discuss from your vantage point what will be the effect on America's investing, public and small businesses if Republicans' insistence on a government default succeeds. I thank you for appearing before us today. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Well, thank you, Madam Chair. And Chairman Gensler, thanks for being here. It's good to see you again. Last time you were here, the Senate had just confirmed you, and it made sense that you're reluctant to speak about the direction of the Commission's agenda. But now that you've had some time to get your sea legs, I'm looking forward to your discussion about regulatory priorities. You've not been shy in the press, so I hope we can have a frank and transparent conversation here today. On digital assets, you've made a number of concerning, in my view, and contradictory public statements regarding crypto assets and other innovative technology. When you were here in May, you stated that there was a need for additional legislation to appropriately regulate and define digital asset and digital asset exchanges. Then, just a few weeks ago, when you testified before the Senate Banking Committee, you stated that there was, quote, a great deal, end quote, of clarity in the law. You implied that many digital asset exchanges are unregistered securities exchanges and even threaten one digital asset exchange by name. So, which is it? Does the SEC want more legislative authority, or is it about to unleash a regulatory tsunami under existing laws? To be frank, I have strong concerns about how you'll regulate in the digital asset space and whether the law is on your side. I believe it's time for Congress to step up and provide clear guidelines that will not allow an SEC chair to change the law by interview or statement or a statement posted on the Commission's website. That's why earlier today I introduced the Clarity for Digital Tokens Act of 2021. We need to nurture innovation and technology in this country, not send it overseas. This bill, which borrows from the great work of SEC Commissioner Hester Peirce, helps bring legal certainty to digital asset projects that we badly need regulatory clarity to launch. Two other points before the time runs out. First, much of your broader agenda appears to be no more investor friendly than the bad bills the majority in the House here continues to push in this committee. There's a bipartisan concern that you'll use, quote, investor protection as a guise for limiting everyday investor choice and run roughshod over appropriate processes in implementing your regulatory agenda. Along the same lines, following appropriate process doesn't seem to be your strong suit. Your move to politicize an independent accounting oversight board by terminating the chair has raised concerns about your commitment to transparency and process. Second, it's a point you and I have spoken about, but I want to raise here. I've sent you several letters that you've received that frankly we've received less than a fulsome response. That's not acceptable. Members of this committee rightly have concerns and questions about your agency and what you're doing and why it has undertaken certain actions. The SEC needs to respond in a timely and substantive manner. I hope that with more time on the job, this problem will correct itself, and my expectation is it will. Thank you for making it a priority. Thank you, Madam Chair, and I yield back.
Thank you very much. I now recognize the gentleman from California, Mr. Sherman, for 1 minute.
Welcome back, Chairman Gensler. Your agency oversees $100 trillion of trades each year, and your budget request, and I know I echo the chairwoman on this, is quite reasonable. It accounts for less than $1 for every $46,000 of trade you oversee. The Pandora Papers have shown the world that all too often billionaires are able to easily evade taxes and dictators then steal what tax money's collected. We need a financial system that is less accommodating to the corrupt. Frances Hogan showed us what's behind Facebook. She is an SEC whistleblower, and I hope that you give her disclosures full consideration, given the fact that she will probably face lawsuits from Facebook. You exercise tremendous power, but particularly over bond rating agencies and the Financial Accounting Standards Board, the two most powerful, almost completely unknown agencies in our society. And investor protection is not a guise, it is your guide. And I support your.
I now recognize the gentleman from Michigan, Mr. Huizinga, for 1 minute.
Thank you, Madam Chair, and Mr. Gensler, congratulations on your new Twitter account. It appears that you, like a lot of folks, including myself, were watching the Olympics Games this summer. because in one of your tweets, you likened adding public company disclosure requirements to the Olympics adding new sporting events, responding to the desires of fans. My problem with this analogy is, frankly, you seem to think that the SEC's power and expertise in disclosure is as unlimited as the IOC's power over the games. Well, I disagree. Just because the SEC generally does a solid job regulating disclosure about financial statements doesn't mean it's well qualified to regulate around environmental topics. I have a different analogy for you. To me, the SEC requiring disclosure on ESG metrics is like if we required the gymnastics judges to judge the diving events. Similar, but they're not qualified. So I hope that you're going to be able to reconsider that. I look forward to this process. And I do question the wisdom of the direction that you are going on a few of these things, and I yield back the balance of my time.
Thank you very much. I want to welcome today's distinguished witness, the Honorable Gary Gensler, the Chair of the United States Securities and Exchange Commission. Without objection, your written statement will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to see a timer on your screen that will indicate how much time you have left. And a chime will go off at the end of your time. I would ask you to be mindful of the timer and quickly wrap up your testimony if you hear the chime. Chair Gensler, you are now recognized for 5 minutes to present your oral testimony.
Good afternoon, Chairwoman Waters, Ranking Member McHenry, all the members of the committee. It's good to be back with you. And I look forward to the day when we can be there in person in that wonderful hearing room. I'm honored to appear here today for the second time as chair of the Securities and Exchange Commission. And as customary, I'll note that my views are my own. I'm not speaking on behalf of my fellow commissioners or staff. I've worked in and around markets my entire adult life. I believe the U.S. capital markets are the best in the world. And there are many reasons that we represent 38% of the world's capital markets. But we can't take our remarkable capital markets for granted. New financial technologies continue to change the face of finance for investors, for businesses around our country. More retail investors also than ever are accessing our markets, and other countries are developing deep competitive capital markets as well. Though I provide greater detail in the written testimony, I'd like to flag just 3 policy broad brush areas. One is market structure. Our mission at the SEC is about capital formation and facilitating capital formation on one side, investor protection on the other. But what's in the middle, that third prong of our mission, is about fair, orderly, efficient markets. I think that we can drive more efficiencies in these markets in the middle, and to the extent we can or able to, that helps capital formation, it helps investors. I've asked staff to look at projects in a number of areas, and the treasury markets, which has had some hiccups in resiliency over the years, non-treasury fixed income markets where possibly we could drive some more efficiency, equity markets, and securities-based swaps and so forth. I think in these critical markets, I think companies, investors alike will benefit if we get greater competition, lower costs, and bring transactions out of the dark. Second is the rapid changes in technology. We're living in transformational times, perhaps as transformational as the internet itself. I know you might be thinking I'm going to say something about crypto. I will, but I think the transformational side is actually in data analytics, predictive data analytics, artificial intelligence, machine learning, are really shaping a lot of parts of our economy. And with these developments, how can we increase access and choice, which is net positives, but also ensure that we make sure that we're still achieving our public policy goals of investor protection and promoting capital formation and the like, and ensuring that we protect against conflicts of interest or biases in the data or systemic risk. Separately, as the ranking member said, and we've had some good private conversations on this as well, I don't think that we have yet enough investor protection in the crypto finance, issuance, trading, or lending area. I've asked the SEC staff, working with fellow regulators at our other agencies, to see what we can do here. Third, issuer disclosure. Since the 1930s, we've had a basic bargain. Investors get to choose what risks they take as long as it's based upon full and fair disclosure of the issuers. Over the decades, we've updated what those disclosures are, and I look forward to talking this further through with Representative Huizinga. But today, the investors are looking for consistent, comparable, and decision-useful disclosures around climate risk, human capital, cybersecurity. So I've asked staff to serve up ideas that we would, if the commission supports those ideas, we put out to public comment and see what investors, because it's all about investors at the core of this. I've also asked staff to develop proposals around potential issues around, as you know, Sarbanes-Oxley passed about 20 years ago, and there was a basic bargain there as well. To issue to the public in the US, you have to open up, your auditor has to open up to inspections by the Public Company Accounting Oversight Board, and though 50 jurisdictions have allowed this, currently China and Hong Kong do not. The SEC, working with the Public Company Accounting Oversight Board, has quickly put in place things to meet the challenges that Congress asked us to work to ensure this would happen. Separately, last month, I want to say we authorized voluntary return to the office. We've been remote for about 19 months now, but it speaks to the dedicated staff of the SEC, and I can't compliment them enough. The last thing I'd say is, as the chair said, we've shrunk about 4 or 5% in the last 4 or 5 years. I would have hoped that we might have grown 4 or 5% at this period of time. I know resources are tight, but it would help us to do our mission. I thank you, and I look forward to your questions.
Thank you very much. I now recognize myself for 5 minutes for questions. Chair Gensler, as I mentioned in my opening statement, I'm deeply concerned about the recklessness of Senate Republicans refusing to vote for any legislation that would allow the Treasury to pay the debts those same Republicans already voted to incur. Last week, Treasury Secretary Janet Yellen said on several occasions that failing to raise the debt ceiling would lead to, quote, a catastrophe. And Fed Chair Powell said it was essential for Congress to act quickly. Chair Gensler, as a former Treasury Secretary and Assistant Secretary focusing on financial markets, as well as a former chair of the CFTC and as chair of the SEC, you are uniquely positioned to describe what will likely happen if Treasury is blocked by Republicans from paying its bills. Can you describe what you expect would happen in our markets, both in the coming days and if Treasury does default? In particular, I would like to know what would likely happen to people's retirement investments and to America's businesses trying to raise capital and create jobs.
Madam Chair, I think we'd be in very uncharted waters. The uncertainties abound around this, but at the base of our entire capital markets is treasuries. It's one of the reasons why we're working so hard to build the resiliency there. But an actual default, we would be in a period of uncertainty. What would happen to money market funds? What would happen to the banks that rely on that marketplace? The mortgage market is priced off of the marketplace, the automobile loans that everybody takes out on a daily basis. And those uncertainties would be very significant. I think that though we don't know for sure, we'd have significant volatility in the markets and we'd see some breakages in the system. But I couldn't predict which firms and the like. We do know that there is such a base of treasuries that underpins our entire capital markets that if that were to go into default, we'd be in for some of the greatest challenges we've seen in our financial sector, much greater probably than what we've seen in the past.
Thank you. As I mentioned, 1/4 of the increase in the debt is directly attributable to the former president's tax scam when he passed a tax cut for the ultra wealthy and Wall Street firms without offsetting it at all. Simultaneously, the Trump administration reduced staffing by the SEC by 5% and did not provide funding to cover the SEC's rising operating costs. This occurred as our capital markets grew significantly, including the huge growth of the crypto assets. Chair Gensler, as you know, the Obama administration sought to double the budget of the SEC and CFTC, but those plans were thwarted by Trump. Please describe how your current budget request, if passed by Congress, would help the agency to fulfill its indispensable mission of protecting those whose savings and work fuel our economy.
So I thank you for that. I mean, at the core, what we are in this three-part mission, helping companies, investors, and the markets themselves, we're effectively a cop on the beat. And we right now this year, I think, have a boom in initial public offerings. So the more resources we have, the more ability we are to help the public and those companies that want to go public, ensuring that their filings provide the disclosures to the public. We help the public in multiple ways, and the markets, as you mentioned, are larger now than 5 years ago. And this is not just about the crypto markets. This is about the base of capital formation for innovators, for the entrepreneurial spirit of the country. So I really believe in the basic bargain in the last 90 years that with our laws and the SEC, we help enhance economic activity with a robust SEC.
Well, thank you very much. I've always been concerned about what appeared to be the Republicans' actions not to fund SEC adequately. And I know that you're the cop on the block, and we need you to be funded in order to do your job. So we are working as hard as we can to give you that kind of support. And I thank you again. It is now time for me to bring on the gentleman from North Carolina, Mr. McHenry, who is a ranking member of the committee. You're now recognized for 5 minutes, Mr. McHenry.
Well, thank you, Madam Chair. Chair Gensler, I am concerned that you're operating on the edges of existing law. You stated in 2018 before this committee, quote, clear rules of the road will allow firms, both incumbents and startups, to more fully explore investing in blockchain technology or crypto assets, end quote. You also indicated in an interview following the GameStop hearing that the SEC will be working with Congress to bring a regime to crypto exchanges. What has changed?
Thank you, Representative McHenry. I think that working with Congress would be a help. And as we've talked about a number of times, I think that the SEC's authorities in this space are clear, but what we could work with Congress on is, along with our sister agency or sibling agency, the Commodity Futures Trading Commission, we both have market oversight. They have oversight over derivatives. We have it over securities. They also have enforcement authority over commodities. And I think that coordination and working not just with this committee, but multiple committees of Congress, we could address. I think also—
So in your view, there is a limitation, though, around what the CFTC, your former job a few years ago, and the SEC, what permit they have under law to regulate these regimes. Is that what you're indicating?
Well, what I'm indicating is I think that Congress painted with a broad brush for the definition of security and included 30 or 35 separate areas that are within the definition of security to protect the public against fraud. But they also wrote in other laws for the Commodity Futures Trading Commission to have authorities. And I think that coordination in working with Congress, we can fill some gaps.
Okay.
We can also fill gaps around stable coins in the banking regulatory regime.
Okay, but filling those gaps. Okay. So along those lines, I think it's important that we have some regime in place under existing law. And I think we have to have clarity in law around what is a digital asset. And I do think, as you noted back in 2018, you noted in your testimony that at the time, the SEC did not view Bitcoin and Ether as securities. Is that still your view?
I think you're referring to when I was at MIT, testimony I gave in front of the this committee in 2019, if I remember. And I was speaking to what the SEC career staff had said. So where the
But I'm
clarity
asking your
is,
view now. I understand all that context. I've done the research, and in fact, I was at that hearing. But is it your view now that that Bitcoin and Ether are not securities?
no, I'm not going to get into any one token, but I think the securities laws are quite clear. If you're raising money from somebody else, and that's something the investing public believes that they anticipate or have a reasonable anticipation of profits based on the efforts of others, that fits within the securities law. And so it
Okay, and
depends on
that's
the
why
facts and
today,
circumstances.
along those same lines, Chairman Gensler, along those same lines, that's why I introduced the Clarity for Digital Tokens Act with Representative Davidson and Budd, based on Commissioner Peirce's digital token safe harbor proposal. I asked about this before. Have you had a chance to review her proposal?
Commissioner Peirce and I talk actively about these matters,
But the safe harbor.
but I have not yet reviewed. I think you just introduced your bill this morning, and I look forward to looking closely at
Yeah,
that.
but the bill is based off of her proposal, and I was asking if you've reviewed her proposal.
Commissioner Peirce and I have had a number of conversations about her thoughts on these.
Okay, so you're not willing to answer that question. Okay,
But
so
no,
look,
she and I have talked about her thoughts on this around a potential safe harbor. I think that the
okay, but
challenge
again,
for the
I
American
understand this.
public
So
is that if we don't
I
oversee
understand
this
this.
and bring it in investor protection, people are going to get hurt.
Look, I understand this is a horrible format for crosstalk here, but what I'm trying to get at here is a broader brush view. You've had a number of media interviews. And so far we've seen some of those comments that you've made have raised questions in the marketplace and have provided less than made things less than clear. And I'd point to a couple of things. You made seemingly off-the-cuff remarks that move markets. You disregarded rulemaking by putting a statement out without due process. And you've essentially run roughshod over American investors, and that's before we even talk about the summarily firing the accounting board oversight board members without cause. My question is the general broad brush here. Is it your intention to follow the Securities and Exchange Commission long-held practice of notice and comment on rulemaking and procedures?
I believe in the Administrative Procedures Act. I think we benefit by getting the public's
And is
input.
your intention to follow through with that?
Time has
It's your
expired.
intention to follow the Administrative Procedures Act?
We follow it, and we put out a proposal last week on fund disclosure, and we look forward to doing that on many of the things on our unified agenda.
Hey, thank you for your testimony.
Thank you, Mr. Gensler. The gentleman's time has since expired. The gentlewoman from New York, Ms. Velasquez, who is also the chair of the House Committee on Small Business, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Commissioner, volatility surrounding the trading of GameStop and other stocks earlier this year have been renewed call for increased transparency and regulation of short selling. Section 929X of Dodd-Frank requires the SEC to develop a rule to increase public reporting of short selling activity, but more than 10 years later, the SEC has yet to promulgate a rule. Where does this rulemaking stand on your list of priorities as commissioner? And when do you think the SEC will propose this rule?
I thank you for highlighting that, Representative. And I've asked staff to propose up to our 5-member commission. And yes, as we were just discussing, that if we vote on it, we put it out to notice and comment around short selling disclosure. This was a mandate Congress laid out, I believe, in the 7 or 8 places that we have unfulfilled mandates, whether it's on executive compensation, short selling, stock loan, some mandates on securities-based swaps. All of those are on our unified agenda. I would hope and anticipate that though we have an active agenda, that we put this out to notice and comment
Okay, so
sometime early next year, and then hear what the public has to say on it.
great. As you know, increasing the transparency of short selling activities is a very important issue for me, as I have consistently seen this practice used against retail investors and working families. We have waited too long for this rulemaking, and I really appreciate if you could keep my staff updated as the SEC moves forward. My office also has heard strong and consistent demand from a wide group of market participants about the need for mandatory climate risk disclosure rulemaking at the SEC. Has the SEC heard a similar type of demand?
We have. There's hundreds of companies. A majority of the biggest 500 companies currently do voluntary disclosures in this space, and trillions of dollars of assets under management have asked for disclosure. So I think this is a place where there's a real role to help bring consistency and comparability, some standardization that would help both the companies and the investors. And again, put it out to notice and comment and see what the public says on what do investors really want when they're making these decisions on climate risk, as you say, but also on human capital. And we've got a project on cyber risk as well.
You have previously stated that the SEC will propose a rule on climate risk disclosure by the end of the year. Do you still feel that this is an appropriate time frame?
Yes, I mean, whether it's towards the end of the year or early next year, because these things, we want to do them, finish up our economic analysis, take comments from each and every one of our commissioners. And again, I don't want to prejudge voting something out. Deep respect, and I think that the commission process is good, but in the next handful of months.
Well, great, so that we don't have to wait 10 more years. Commissioner Gensler, like the other rule, this committee passed my bill, the Greater Accountability in Pay Act. And my bill builds on Dodd-Frank CEO pay ratio disclosure requirement by requiring public companies to disclose the ratio between the pay raise percentage of each executive and its median employees over the previous year. Can you explain how this bill will help increase the accuracy of equity prices, allow investors to make more informed decisions, and allow the SEC to provide better oversight of our capital markets?
Congresswoman, if I could go a little broader, I think that investors benefit by understanding and having transparency about executive compensation. And there's a number of features, including your bill, to do that. We still have three important rules that Congress asked us to do and to finish up on. And so we're moving forward on each of those. About one was called clawbacks, a simple concept that executives got paid on financials that had to get revised, then some of their pay would go back. There's something called pay for performance, and we're going to try to, staff is working on that to propose that out. And we last week even had more disclosure with regard to say on pay, that funds would disclose their votes. But I think all in all, it helps the efficiency of markets where investors get to decide when they have that full and fair disclosure on executive compensation.
Thank you very much. The gentlewoman's time has expired. The gentlewoman, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Chair Gensler, welcome back. In much of your commentary on payment for order flow, you've suggested that investors may not be receiving best execution. Can you provide us with more specificity on why it is you believe the duty of best execution may have been violated by retail brokers?
So you raise, I thank you for asking that. There's the potential for the conflict of interest when my order or anybody's order is not routed in competition with other orders, but is routed to a wholesaler or a broker who's purchasing that order flow. And so when we back away from order by order competition, and it may well be about algorithms or formulas between a broker and a wholesaler without transparency, there may not be best execution.
Well, I could say that, one leading brokerage firm found that last year they had billions of dollars of price improvement by executing through wholesalers, with 90% of trades finding price improvement. This particular broker received payment for order flow, but ultimately the retail trader received a better price than they could have received on say an exchange. Isn't that a good thing, Chair Gensler?
So price improvement is a good thing, but I think the measuring rod of that price improvement is off of something called the national best bid, best offer that does not reflect the full market. 16 years ago, when these rules were put in place, they may have been fit for 2005, but so much has changed in those 16 years. I've really asked staff to say, what can we do to update this for the 2020s? And that national best bid offer has constraints in it. A lot's not in it. It also has an increment that it can't be narrower than penny size. So there's a lot of reasons why this may not be the most efficient.
Chair Gensler, you received significant attention recently when you were quoted as saying a ban of payment for order flow is, quote, on the table, a ban. Can you explain what banning payment for order flow would achieve? And if payment for order flow were banned, do you anticipate that retail trading would remain commission free?
So we're motivated by our three-part mission, and the core in the middle is efficient, competitive markets. So I've asked staff, how can we help ensure even enhancing that efficiency? So right now, as you mentioned about commission or zero commission does not mean it's free. It does have some cost inside. Some brokers have payment for order flow. I would note some do not and also offer zero commission trading.
Pennies. I would have to say pennies. So, I would certainly hope that a ban of payment for order flow is not, quote, on the table. Chair Gensler, turning to Reg BI, the SEC adopted Regulation Best Interests, Reg BI, on June 5th, 2019. It was the culmination of a comprehensive, many years long effort to enhance the standards of conduct for financial professionals that advise retail investors. The benefits of Reg BI to the capital markets are abundantly clear, and there is little doubt that investors are better off today than they were previously. Chair Gensler, you have brought on staff with a clear public record of opposing Reg BI. You can understand how that would give the investing public the impression that the SEC, under your leadership, is not committed to Reg BI. And I'd like to point out that during your confirmation process, you committed to working with commission staff to ensure Reg BI, and again I quote, lives up to its best interest label. Do you still commit, sir, fully to to supporting the continued implementation of Reg BI?
I think that is as true today as when I said it. To ensure that our regulation best interest and others live up to what's in written down on the page, and really is regulation best interest is that investors are getting the best interest when a broker is making recommendations.
Well, great. I'm very relieved to hear that. I have run out of time and I yield back. I have some other questions, but I'll submit them for the record. Thank you, Madam Chairwoman.
Thank you very much. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets. Now recognized for 5 minutes, Mr. Sherman.
Before I begin my 5 minutes, I have a unanimous consent request. I request unanimous consent to enter into the record letters from the Los Angeles County Employees Retirement Association, Healthy Markets Association.
Without objection, such is the order.
Rail Penn, Certified Financial Planners Board of Standards, which express support for certain discussion drafts that are in front of us today, including those to improve the Office of Investor Advocate. I'll now begin my 5 minutes by focusing on the PCAOB. Chairman Gensler, thank you for mentioning that in your opening statement. And thank you for your work in implementing the Holding Foreign Companies Accountable Act, legislation that Senator Kennedy and I led in Congress last year. During your testimony in Senate Banking, you expressed support for a revision to this law, which would shrink the amount of time from 3 years to 2 years for U.S. listed foreign companies, basically Chinese companies, to provide the PCAOB with the access it needs to assure that the company's audit is was done accurately. As you know, the primary purpose of the bill is to give the PCAOB and the SEC the leverage needed to reach agreements with market regulators in China. Do you believe that this 2-year time frame is consistent with the objective of assuring that companies listed on U.S. exchanges have accurate audits?
We've been, I guess, 18 years now since this basic bargain was put in place, and 50 plus jurisdictions have allowed the Public Company Accounting Oversight Board access to the work papers. And access means unfettered access, that they can pick which work papers to see, they see it, they're not redacted, they can talk to the audit staff and talk to them openly and assess whether the audit is up to the standards. And there's been a challenge that's not been the case with China or more recently with Hong Kong. So I think that if Congress decided to shorten it from 3 years to 2 years, I'm supportive of that. That's up to Congress. We're going to continue to work with the PCAOB to make sure that everything's in place. Year 1 is 2021. If there's any ambiguity about that, year 2 right now would be 2022 and so forth.
Thank you. And having been an auditor myself and prepared work papers, I understand why you need that, or the PCAOB needs that unfettered access. A couple of comments about points that have been raised. The ranking member argues that crypto is somehow not an investment or not subject to SEC oversight. I would say cryptocurrency is not at this stage a currency. The vast majority of people who are buying it are not buying it in order to go out and buy a ham sandwich with it. They're buying it because they think it'll go up and they can sell it for more dollars than they invested in it. It is an investment like many other investments, and investors need protection and deserve protection. As to commission-free trades, free is very expensive, is free is illusory. And being told that their trades are free can lead to high-frequency trading. The investor deserves the best more than best execution, because best execution is a misnomer. They deserve not only price improvement, but the most price improvement. And a system which tells them it's free but doesn't give them the most possible price improvement is certainly illusory. We looked at Archegos as many people focused on that as a family office issue. I focus on it as a margin issue. Every investor in the country is told, okay, you have so much in your brokerage account, you can borrow up to half of what's in that account. That's your margin limit. And that has been the law since people were jumping out of the windows in the 1930s when they saw their stocks go precipitously down. But we found with Archegos that they figured out a way to use total total return swaps to give themselves 8 times rather than put up only 1/8 or even 1/10 of the money. Should we either allow ordinary investors to borrow 10 times the value of their portfolios, or should we prevent big guys like Archegos from doing it? Or should we have one rule for small investors and another rule for those sophisticated to engage in total return swaps?
Well, I think that the events of March and the family office you mentioned raised a number of questions. I think that we should have, in terms of your central question about margins, some more consistency. We do have, with Congress's authority, we do have rules that are going into effect in November. The commission, prior to my getting there, voted out that securities-based swap dealers had to register as of November 1st. They have to report their trades as of November 8th. Some of that will be reported publicly next February. I've also asked staff to do more work and recommend it up to us. Can we put out to public comment a rule around the aggregates positions? You know, family office that you mentioned, Archegos, they're aggregate positions of total return swaps.
Thank you. The gentleman's time has expired. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair, for holding this hearing. Chairman Gensler, as always, it's good to be with you again. Perhaps only a few of our colleagues remember the amount of time when you were CFTC chairman and I was the Ag Committee chairman that we spent in quality hearings. Of course, you'll always note that I focus on things that are important at home. And today I would like to put my particular perspective on the upcoming climate risk disclosure rulemaking that's generated a lot of interest here in Oklahoma, since we are both producers of traditional and renewable energy, and as well an ag area that consumes a great deal of energy. So with that, Mr. Chair, publicly traded companies are at varying stages of climate and ESG disclosure, and the related reporting and climate modeling is still an evolving practice. Chairman, are you concerned that the upcoming climate risk framework could have an outsized burden on small to medium-sized companies? And how might the SEC account for this?
So I'm really looking forward, with the support of my fellow commissioners, to try to put something out to public comment. And a question that you just raised, to include questions like that to the public as to large issuers versus small issuers, as you mentioned. And also, I think implicit in what you're saying is some reporting will be easier to do sooner. I've asked staff to do a look at qualitative disclosure about governance and strategy, but also quantitative disclosure to make sure that the disclosures people are making, particularly around greenhouse gas emissions, have consistency, but how to potentially even phase the implementation amongst large and small issuers, and also amongst the different types of disclosures.
Because many would argue, I think quite correctly, that the small and medium-sized companies are the real generators of opportunity, are the real generators of growth. So we don't want to harm their ability to compete with their big brothers and sisters, so to speak. That said, continuing to think about this issue, you've said your staff is considering quantitative factors such as metrics related to greenhouse gas emissions, climate change, financial impacts, and advancements towards climate-related goals. You've also mentioned many times today about the importance of staff, and we all know that they're critical to whichever branch of the federal government you're in. Could you describe the current depth of climate expertise at the SEC? Are there currently climate and environmental scientists on staff? And is the commission engaged with agencies such as NOAA, the EPA, and the Department of Energy regarding the climate risk rulemaking process?
The answer, the expertise of the SEC is around disclosure about ensuring that the public, looking at the disclosures that are currently, and again, hundreds of companies are making voluntary disclosures now, trying to bring some consistency and comparability to those disclosures. To your second question, yes, we've been in conversations with other important parts of the U.S. government.
It's absolutely important, and as much faith as I have in the MBAs and the attorneys and the poli-sci people, it's important that these other scientific disciplines be involved in this process. Whether it is consulting with the other entities in the federal government that have that expertise or drawing on it from somewhere else, This is too important just to create rules and regs. It has to be done, I think, Mr. Chairman, you and I both would agree, in a very thoughtful fashion. So with that, Chairman Gensler, you've announced that the SEC is considering a review of Treasury market structure. Could you discuss what this review might entail, how you're coordinating it with the Fed and the Treasury Department, and how you might think about the cost and benefits of potential changes?
So we've had a number of challenges in our U.S. Treasury markets dating back to 2014 when there was problems in the pricing in the market. But then in 2019 and 2020, where literally our central bank, the Federal Reserve, was providing liquidity to the market because there were challenges in the financial resiliency. Working closely with our colleagues at the Federal Reserve and Treasury, and also the Commodity Futures Trading Commission has a role here. What we're trying to think through is how we could build greater resiliency into the market. We have $23 trillion market. It's at the base of everything else we do in the capital markets. And right now, if I can use a term, we have kind of a multi-nodal system where we have a clearinghouse, we have interdealer brokers, we have big market makers, both principal trading firms and big banks. And if any one of those got into challenges, as we saw last spring and the fall of 2019, our central bank tends to get pulled into providing resiliency. And so we're looking, can we do this better around potentially central clearing? Jay Clayton took up, could we put some rules in place about the trading platforms themselves and the like?
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Chair Gensler, I first want to start out by saying that I am extremely pleased to see that you are serving as the chair of our SEC. I appreciate that you and I have had an open dialogue on issues that touch both on the Committee on Financial Services as well as the House Foreign Affairs Committee in my capacity as chairman there, including the cost and the benefits of a wide-scale Chinese delistment from American markets. But I also want to commend you on moving the needle to increase more diversity and transparency in corporate boardrooms, and also overall promoting better diversity in human capital practices and the industry as a whole. The SEC's recent vote to approve new listing rules to enhance corporate board diversity disclosures is a necessary first step, not only because diversity of thought is a proven positive factor for companies who succeed, but also because investors are demanding that their boards be diverse. And as you know, my bill, the Improving Corporate Governance Through Diversity Act, passed through the House recently, and I'm grateful that you are continuing these efforts. The newly approved rules, however, are just the beginning, since that is specific to NASDAQ, and there are companies listed on other exchanges that will not need to comply with these rules. So my question to you, Mr. Chairman, is can you please elaborate on what other types of actions the SEC is planning to take with respect to promoting diversity specifically?
Thank you, and it's good to see you. I think we first worked together when I was a staffer to Paul Sarbanes some 20 years ago. So, but I've asked staff to serve up to us two important potential rulemakings in this area. One related to the workforces of America and public companies. Human capital is probably one of the most critical assets of a company, and building upon what the Commission did last year to give more specific disclosures about the workforce, part-time versus full-time, labor rates and the like, but also about the diversity of the workforce. U.S. companies now disclose to the Department of Labor through EEO-1 filings and the like around their diversity. And I've asked the question, would it be helpful to investors to understand that? In addition, you raised the question about board diversity, and I've asked staff for recommendations around the boards. That's only 10 or 15 people usually on these boards, or 6 to 15, but it's the leadership. And what it's really about, investors want to know, and whether we should do a rule to be considered by our commission on board diversity as well.
Thank you for that. I look forward to continue to work you there. Now, let me go. You've also expressed serious concerns over the loopholes and potential abuses that exist within the 10b5-1 plan framework, which serves as an affirmative defense for insiders so that they make trades according to specific plans without it constituting insider trading. But the existing framework allows for a lot of different types of opportunistic trading where they could have had material non-public information, but because they had set up a 10b5-1 plan, it's not considered insider trading. And we've seen that executives of large companies cancel their plans or implement a plan and have the trade executed a few days later. And they end up netting significant amounts of money. But the question we should ask is, why did they cancel their plans, or why did they implement a plan that allows them to trade shortly after the plan was put in place? If it is because they have some inside information, then we need to address that loophole in the framework. So is there an obvious need for the 10b5-1 framework to change? And Chair, can you please describe the types of loopholes that exist in the 10b5-1 plan framework and what Congress can do to assist the SEC in addressing these loopholes?
I do think that there are gaps in this. In 20 years of this so-called safe harbor or affirmative defense for insiders to sell their securities, that right now they can have multiple plans. They can, as you said, cancel them on a daily basis, put up a new one, and the like. One of the best practices that's out there, and there are many best practices out there, is to have a cooling off period. And I think my predecessor wrote to Congress about this as well. So I've asked staff for recommendations around whether we should have a required cooling off period if you want to say you have this affirmative defense, whether you could have just one plan rather than multiple plans and the like. So I think there is work to be done here.
Thank you very much. The gentleman's time has expired. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. One of the charter purposes of the SEC is to facilitate capital formation. Last week, a member of the committee asked Secretary Yellen how the administration's proposals to increase capital gains taxes, qualified dividends, and corporate tax rates would affect the competitiveness of American companies. Given your responsibility for capital formation and the research of the SEC, my question is, how would those new taxes impact the competitiveness of the United States to attract capital and investment in the world economy?
Congressman Posey, I think that our remit is about the capital markets, and if it's all right, I think I should leave to Congress and the other parts of the executive branch to sort through taxes. But in terms of our markets, it's about transparency, it's about disclosure, it's about protecting against fraud, and it's facilitating these vibrant capital markets. Regardless, over the decades, Congress has decided on high capital gains and low capital gains, but we sort of are leave that to others and then try to facilitate through our rules the most vibrant capital markets for capital formation.
Well, that's a good walk around the block, but you know, one of your charter purposes is to facilitate capital formation, and I'm just trying to find out if more taxes on corporate America and working Americans is the right direction to go from your perspective.
Again, I do appreciate the question, and if I weren't in the current role, I might have a lively discussion as a professor at MIT, but in the role that I have right now, it's really to facilitate capital formation through the tools that Congress has given the SEC, the tools of anti-fraud, anti-manipulation, and a focus on registering exchanges so that there's really efficiency in the middle of the market. Those are the important tools, whether Congress raises a tax rate or lowers a tax rate.
Okay, and you know, just an assumption. I'm sure nobody else in the world is thinking this right now, but you know, the refusal to say yes or no kind of indicates that the answer is probably one you don't want to give, and that in fact the higher taxes are going to actually hurt your ability to.
I respect that. I just think that, I mean, there's things that you want me to discuss, crypto and China disclosures and the PCAOB and the structure of equity markets, the structure of treasury markets, but I think you'd want me to leave tax policy to Congress and the executive branch.
Well, setting the policy is definitely the job of Congress and the executive branch. Just one, I think the average common person in the street would think that, the chairman of the SEC would have an opinion about whether we should tax American companies and American people and American families more, if that helps you do your job, or if it doesn't help you do your job.
What best helps do a job is discussions like this, of course, and trying to get the right resources to the SEC, and then working with my fellow commissioners to try to enhance our capital markets given the rapidly changing technology. I think tax rates, again, are the remit of Congress and the executive branch.
Well, I'm not trying to beat you up, and so I don't want to beat a dead horse. We'll just leave this subject for now. Given the time you've been at the SEC, have you identified any regulations or restrictions on capital markets that you think could actually be relaxed? And if so, what restrictions could be relaxed?
So I think in each of these reviews, and particularly as we review the treasury market structure and the equity market structure, what I've asked is, how can we, in the 2020s, ensure that they're most resilient and efficient? And I think that that's really a critical thing that we can do. And the efficiency in the capital markets might, as you said, be turning a dial or changing some of our current rules. I'd also say in the crypto space, when I've said publicly that these platforms come in, talk to us, get registered, these trading and lending platforms, it's highly unlikely with 50, 100, or sometimes thousands of tokens that they don't have securities. But if they come in and they say, that transfer agent rule doesn't quite fit, or this custody rule doesn't quite fit for these new forms of capital formation, we should get into those discussions and talk about how we stay true to the mission that Congress wants us to do. But if we need to adjust some of these, sometimes very technical rules that were written in a different environment, we should see what we can adjust.
Thank you very much. The gentleman's time has expired. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you. Chairman Gensler, how are you? First thing I want to say, Chairman, is congratulations. As both you and I are graduates of the Wharton School of Finance at the University of Pennsylvania in Philadelphia, where we received our MBAs, Master of Business Administration, we all are very proud of you. And plus, I think you're the only one now who's been both chairman of the CFTC and chairman of the SEC. What an accomplishment. Let me start off here because I'm so excited about one of the first things that you have done at the SEC is establish climate change as one of your top priorities. And as chairman of our House Agriculture Committee, I make climate change a very important part. We just had Greta Garbo's hearings to get us started in that. But my question is that you have released a newly proposed environmental social governance regulation. Tell us, how exposed is our financial and security system to these weather patterns and monetarily, investment, equipment, the floods up north in New York, the fires burning up half of the West? This is serious. What is the economic and financial impact in your arena in terms of securities?
Well, I thank you for asking that. I would note that I'm the second person to have this honor, and the first was Mary Shapiro, who chaired both of these great commissions. And the reason I mention is she's also, subsequent to being at the SEC, done a lot of work on climate risk disclosure. So we're trying to build upon the work of something that investors have come to look to, this task force on climate financial disclosure, or TCFD, that Mary is now working at. I also want to say that it's really up to investors. Investors are looking for this disclosure because climate risk can affect a company, and it could affect their physical risk. I mean, if a flood comes, hurricanes come, or other physical indicia of climate risk hit a company. And then there's also transition risk, that companies may be adjusting their business models for their own self-declared goals. Many companies have said publicly they're going to have lower emissions or net zero emissions at some future date, but also jurisdictions have. So what they might be doing, what their jurisdictions might be doing, what their customers and competitors might be doing could affect their transition paths in the future. So investors want to know more.
Chairman, I want to get to this other question because it's so important too. And much has been made about GameStop and Reddit and Robinhood and all of that. What are you doing to protect investors, protect our security system? And then secondly, what can and must Congress do to stop this? Put punitive measures, making it a felony. We got to get tough so that we can protect. Our financial system is the heart and soul. And within that, it is our investment, our stock markets, that must be held away from this mess. So what can we do? What can Congress do to put some strong punitive measures in to stop this fraudulent behavior with our social media?
Well, the GameStop events raised numerous issues, some of which are in the plumbing and the infrastructure of clearinghouses, but you're at another level about whether there was things that Congress could do to address the challenges there. What we're doing at the SEC is 3 or 4 different projects. The plumbing, which I talked about, the clearing, trying to shorten the clearing cycles. 2 is we put out for comment for the public to weigh in on use of digital engagement practices. And 3, I've asked the staff.
I know my time is getting short here, but I do want to say this, Chairman. I have asked my staff to begin putting together a bill that we can have strong enforcement powers, put fines in, put jail sentences in, make it tough so we will not allow these social media platforms to abuse the basic foundation of our great nation. Rests in our stock exchange. You and I both studied that. We got to protect our financial system. So I'd like to call upon you at some point to get further ideas. Thank you, Madam Chairman.
Gentleman's time has expired. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Gensler, for showing up today. I appreciate that. I wish Chair Yellen would adhere to her constitutional and legal authority to actually show up in small business. It'd be nice if she would do that. Maybe you could talk to her about that, perhaps. My question starts out with, there was an article in the Wall Street Journal yesterday outlining how private companies are urging FASB to create accounting standards related to cryptocurrency and ESG. I know you're examining some of the rulemaking with regards to these subjects, and specifically through CECL, standards are being set by FASB, which they ignore industry participants as well as the financial well-being of the American consumer. I'm currently working on legislation to enhance the transparency of FASB's standard setting process. And so my question is, do you think FASB is the appropriate entity to determine how assets related to crypto and ESG are treated? and not regulators who must follow the Administrative Procedures Act and significant notice and comment?
Three parts to your question. With regard to climate risk, with regard to other matters on crypto, I think that we're going to put out things to notice and comment. Disclosure mandates over the decades have really been the remit of the Securities and Exchange Commission where appropriate, and we enhance them based upon the process of notice and comment as you talked. On crypto as well, I think that's not just the SEC, but the CFTC, the bank regulators. I think we've got a lot of work to do, and maybe even as earlier discussions with other members, Representative McHenry, with Congress as well. So I'm not familiar with what FASB is doing specifically with regard to crypto or climate risk, but if it relates to the financial statements, the footnotes to the financial statements, it may well be that they have a project on how, for instance, crypto assets are reflected on the financials. I'd be glad to work with your staff and you to better understand that.
I appreciate that. Well, the Wall Street Journal had the article yesterday, so it's something you and your staff could review, see if it's apropos for your getting involved. Along that line, you and I talked offline a while ago with regards to the ESG situation. I've got some broker friends that are talking to me and telling me, look, there's a bunch of companies that want to be able to be for people to invest in if they are going to be the green companies, and so they fill out forms or they add on to their website, nothing more than that they're now green, to support green activities, or they're doing this or that. Are you going to set some standards so that these companies that say that they're green companies that people are investing in because of that are actually doing something along that line? Because I think, to me, this is misleading the investors. A lot of retirement funds and certain investors want to invest in green companies, and if they're just putting this on their website saying, hey, I'm a green company, without doing the things to qualify for that, I think they're misleading the public. What's your concern about that?
So we have a project also about investment funds, investment managers. If they name themselves something, whether it's green, sustainable, climate free, et cetera, what stands behind that? I think that the markets would benefit, and it sounds like we might agree on this, is that would benefit that there's rigor behind that, the same way as if you named yourself to say, I'm a high yield bond fund, that you're actually buying high yield, bonds underneath it. And I think that would help. When I walk into a grocery store that says fat free on it, I can look at a label and there's something behind that actually meaningful. On the company side, we're looking at disclosures as well, and I'd love to, work with you and understand if you think on the company side there's something we could do as well.
Thank you for that. Last time you were in front of the committee, we discussed the SEC issuing a rulemaking on guidance similar to the prudential regulators. You said you review what the prudential regulators have done and get back to me. Have you reviewed what the prudential regulators have done with regard to guidance?
I'm sorry, guidance. I just want to make sure on which of the topics are you still speaking about climate?
Is that some regulators want to go out here and use guidance instead of rules, and then they go out and enforce guidance, which is not basically guidance, as you all know, should be something more than clarification or to be a FAQ or something that they can give some guidance on, not a rule on which you can enforce the law.
I have, as it relates to the SEC, done as we had talked about in the past. I didn't know if you were asking about guidance from bank regulators on other subjects, for instance, around climate. But as it relates to the SEC, yes.
Okay. Thank you very much. I see my time has expired. Madam Chair, I yield back.
Thank you very much. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the subcommittee on housing, community development, and insurance, is now recognized for 5 minutes. Mr. Cleaver? Mr. Cleaver is not on the platform. Next, we will have Mr. Green. Mr. Green on the platform? Then we'll move to the gentleman from Florida, Mr. Lawson. You're now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for this hearing. This is a very good hearing. Chairman Gensler, the committee has held 3 hearings on GameStop, and you have testified on this issue surrounding January the 28th. In each of those hearings, the payment of order flow has been raised as a topic. You have stated that the SEC is looking into the order flow and will make a determination on how to further regulate the product. Do you agree that the Commission Free Trading have indeed increased market participation among minorities and women? I'm particularly concerned about the impact on zero commission trades and whether those will be valuable in the absence of the payment order flow. How will you ensure that any changes made by the SEC do not create additional barriers of entry for those in new market participation?
I think you raised an important point. The projects that we work on are trying to drive towards lower cost, greater efficiency, greater competition in our markets, the stock market in this case. And payment for order flow has been used by some brokerage firms, not all, but some brokerage firms, and they say this helps them provide a zero commission. There are other brokerage firms that have zero commission and don't use payment for order flow. Our focus will be on the overall market structure and, as you say, access to the capital markets. We've got growing retail participation in the markets. That's good. Investing, it tends to be over time good, but active trading on a daily basis often lowers returns. And some of these brokerage apps are also facilitating and even promoting that with their the way they use behavioral prompts and the like.
Okay, thank you very much. And as you know, under your predecessor, the SEC approved changes to the exempt offering private security framework that would increase the limit for how much an issuer can raise in a single offering, establish new safe harbors for integration, and ease some restriction on communication between issuers and investors. Today, 2/3 of capital raised in the United States is done through the exempt offering. Could you elaborate on that, please, sir?
So you're absolutely right that over the decades, the SEC has facilitated through various exemptions, which are called exempt offerings, capital raising both in the public market and in the private markets. And so we have both that are facilitating capital formation. And I think what's important is to ensure that investors get full and fair disclosure. In our public markets, that's been our basic bargain, but even in the private markets, there's pension funds that stand behind it and working families and retirees that stand behind it to ensure that there's an appropriate set of regimes that help them as well.
Okay, thank you. See if I can get this other one in. Until recently, most broker dealers that serve retail investors did not transact in cryptocurrency. In fact, they wanted nothing to do with it for a host of reasons. However, over the last year or two, this has changed drastically. In some cases, the crypto investment are traded on the same platform as securities. They are almost fungible in the sense that an investor can buy one and sell the other, and yet the crypto market is underregulated. Can you comment on that?
I think you're right. I think if we don't get our these exchanges, these lending platforms inside of the public policy framework, a lot of people are going to be hurt. It's a highly speculative idea that a token that may not have any ownership, they're all structured differently, and it's trading in the marketplace on the efforts of others, the potential that in the future it might be worth something because others will pay for it, highly speculative. and it's not inside of our. They're not registering yet, and we're gonna use our authorities. I think it's clear that many of these projects are within the securities laws, and we're going to use our authorities and try to get more of these projects and companies to register and be within the investor protection framework.
Thank you, Madam Chair. I yield back.
Thank you. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair. And first, I want to associate myself with the comments from Mr. Lawson about his concerns about access for trades. Free stock trades is something that is apparently an anathema to some, and it may go the way of the free checking account if we're not careful. And with the Dodo-Frank Act bird being released here, so now I do also need to comment. It might be Tuesday, but it's Wacky Wednesday here on Financial Services Committee, where stock trades aren't free, but spending trillions of dollars has no cost and is free, yet allowing taxpayers to keep their own money is a, quote, cost to government. So it's upside down world for many Americans that are looking in. Mr. Gensler, I want to talk about PCAOB. You've heard a lot about ESG. We can have that conversation later. PCAOB, when the creation of the PCAOB happened, the word independent appeared in statute 10 times. I'm concerned about your unceremonious dismissal of Mr. Dunkey and then soliciting nominations for all 5 board positions. Obviously, that prompted a couple of other commissioners to resign with doubts about the independence of this. To date, you haven't provided a satisfactory explanation for removing Mr. Dunkey or your overhaul of the board. And frankly, our investigation hasn't turned up any good reason for those actions. All of this, I believe, creates the appearance that you fired Mr. Dunkey to appease partisan groups on the left and people like Senators Warren and Sanders. So, Mr. Gensler, is the PCAOB truly independent, and does it frankly need to be?
Thank you for the question, and I think the Supreme Court actually addressed this in a case about 11 years ago, Free Enterprise, and my predecessor, Chair Clayton, used those authorities. The Supreme Court said that the 5-member commission of the SEC has reporting to it this PCAOB. We review its rules, we review its standards, and yes, as Chair Clayton did, we can remove the board.
This is, and the ranking member is right. This is why this format's terrible. We can't get our questions answered. How does Mr. Dunkey's successor make decisions without thinking that the SEC chair is looking over their shoulder?
Well, in fact, I think that's what Congress put in place, that all the standards and rules of the PCAOB are reviewed by the SEC. I think actually that's what the statute says, that we're supposed to do that.
So that is the structure. So, okay, as long as we have that established, that is understood. So here's what I would like to know. If the commission has the review of the SEC, can you confirm that your office or the office of the chief accountant at the SEC has either reviewed press releases or other materials from the PCAOB or its members before those materials have been made public?
I'm glad to chat with your staff to understand the question better, but I don't think it's a press release by press release. But their rules, for instance, on the Holding Foreign Company Accountable Act came up to us. We put it out to notice and comment. We'll vote on that in about a month or month and a half's time. I mean, there's a process around these.
Have you systematically required the PCAOB to run things through your office before they are cleared?
Again, as it relates to the rulemaking and the standards, there's a process that goes forth.
This is why it's important for us. The material that has been requested by the ranking member as well has been ignored. At this point, I would actually like to call on the chair to join with that so that we can get all of this information. So we'll follow up on that. Along those lines, I have actually dropped a bill today that is called Streamlining Company Accounting Oversight Act. It will get rid of the PCAOB, fold it into the SEC. Like your review of that, I don't expect your reaction right now. I think that that might get at what you're talking about. So we can just be honest with everybody that it's a political appointment and a political organization. Facebook, real quickly, is Facebook a utility? Should it be treated as a utility?
I think you're talking about a social media company, and all social media companies as private companies. That would be up to Congress to address
No,
the issue you're talking about.
If you look up Cornell Law's definition of what a public utility is, it clearly, because they're publicly traded companies as well, there are certain criteria which makes privately held companies, or I'm sorry, publicly held companies, utilities. So I want to know whether you think Facebook is a utility or not.
The gentleman's time has expired. The gentleman from Illinois, Mr. Gaston, who is also the vice chair of the subcommittee on investor protection, entrepreneurship, and capital markets, is now recognized for 5 minutes.
Thank you, Chair Waters. Chairman Gensler, it's lovely to see you again. You and I have spent a lot of time talking about gamification, and it certainly seems to be in the news a bit today, and in particularly the ways that social media use psychological triggers to drive some fairly self-destructive behaviors. It was the comment that Ms. Hogan's made on 60 Minutes earlier this week that said, if you make the algorithm safer, people will spend less time on it. And at least for me, that sort of felt like a gut punch in our Robinhood hearings, because what the algorithm is to Facebook is what gamification is to Robinhood. And of course, the pernicious incentives created by ad revenue for Facebook are quite similar to the pernicious incentives created by payment for order flow revenue to Robinhood, especially when they are earning a percent of the spread in the PFOF, not just a flat fee. My question for you is really just in your digital engagement practices work you're doing. I'm hoping you can confirm for me that those issues, and specifically the conflicts between looking out for investors' best interests and the ways that those companies earn money, that will be a subject of your investigation. And if you can confirm that, that's great. I can go on to the next one. And if not, I'd love to hear why not.
Yes, I think it's central. I think it's an issue of our day that digital analytics are being used to not only optimize for our returns, but may be used to optimize for the company, the platform's revenues. And if they're being done that way in a robo-advisor, an investment advisor, or a brokerage, then that creates a conflict. It might create a more fun environment for us. Well, that's okay. But is it also creating more revenues, and what is that conflict there? And how do we protect investors?
Okay, well, I'm delighted to hear that, and we can follow up offline. I want to shift to climate. Some of my colleagues across the aisle seem to think that the primary question in our climate is whether disclosure might increase the compliance costs for small mom and pop businesses. I would suggest that's not even in the top 100 issues that are caused by climate. Leaving that aside, the bill that I introduced, that we of course passed on the House floor to direct the GAO, not your agency, but very similar to the work you're doing on climate risk disclosure, was really driven by 3 issues. Number one, there's massive investor demand. We're going to be almost a third of assets under management are in ESG funds. So let's give investors what they want, as long as we're espousing supporting the interests of investors. Number 2, investor protection. I would echo what Mr. Luetkemeyer said, that as long as a company can stand up and say, I will be net zero by 2035, and their auditor has no way of knowing what that means, that we've got a gap. And I'm delighted to see you starting to put some boundaries around what those rules are. The third one is one that is, I'm not sure if this is subject to your jurisdiction or others, but it's a broader question of financial market stability. If we don't have the data from the affected firms, then we don't know where the risks are parked in our financial structures, where these cash flows are going to happen from. We're looking at huge cash flows from transition risks, from physical risks. And we've got a bill separately we've been working on with Senator Schatz, which is really more directed at Treasury to figure out how to sort of calculate that and monetize and put barriers around those financial risks. But one of the pieces that, as we've dug into this, is I haven't been able to get a good answer to is figuring out where the monetary flows are going to be is the easy question. Figuring out the capital structure of those flows is really hard. So if I know that a certain company is going to see a huge loss of value, but I don't know how much of their capital structure is tied to senior debt, junior debt, equity, and trying to figure out where that sits, because even for public companies, sometimes the precise rules of their credit agreements are not always disclosed. So my question is, in your work on climate disclosure, are you going to be considering requiring companies to provide details of their capital structures in addition to their contribution or exposure to climate change? Or is that a question better asked to other financial agencies?
Given that the clock's ticking, it might be good to just follow up and we can chat offline after this hearing. But our focus is really, what do investors demand and want to make their investment decisions? So for public companies, it's around that and the climate risk, qualitative and quantitative disclosures. But I'd like to better understand about the capital structure, because companies already have to disclose, public companies, a lot about their capital structure. And it sounds like you have some thoughts that's, how should I say, is falling short some way. So I'd like to understand where that's falling short with investors, as in essence, our clients are the investors.
Okay, well, I apologize for rambling on so long, but I'm out of time, and let's follow up offline. Madam Chair, just before I yield back, I'd like to request unanimous consent to include into the hearing record the following letters supporting many of today's discussion drafts from Americans for Financial Reform, Public Citizen, Ohio Public Employees Retirement System, and Ohio Public Employees Retirement System.
Without objection, such is the order. Thank you.
Thank you, and I yield back.
The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes. Who's next? Is Mr. Barr on the platform? If not, let's go on to the next person. If Mr. Barr is not there, next we will get Mr. Williams. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairman. And first of all, I want to, just in full disclosure, I didn't go to Wharton, but I'm a business guy, and I know when you increase taxes, that's bad. When you cut taxes, that's good. Maybe that'll help some of your thought process. In any industry, allowing the private sector to innovate is key to bringing new products and services to the marketplace. This has been especially true in the capital market space with the advent of zero-cost trading because of payment for order flow. This partnership has allowed an entire generation of investors to enter the marketplace for the first time and has made zero-commission trading the new industry standard. And in the past, you've been recognized how payment for order flow has created a significantly lower cost environment for retail traders to place trades. There are studies that have shown this proactive has resulted in a price improvement of over $3.7 billion last year alone for retail investors. Despite these benefits, the SEC is still contemplating a complete ban on this practice and even expanding the definition to include rebates being offered by the exchanges. This seems like a drastic measure that is a response to misdiagnosing the entire GameStop saga that happened earlier this year. So, Mr. Chairman, it's good to see you again. And as you look at making changes to this practice, I urge you to also consider the benefits that this has given all retail investors. So my question is, can you describe the overall growth trends of retail investor participation since the advent of zero commission trading, and what you think would happen if payment for order flow or these rebates were eliminated?
I thank you for that. And retail investing has increased. It's increased probably for multiple reasons, but zero commission and frankly, just even the facility, the ability to trade on a mobile phone with ease has facilitated it as well, regardless of the price. There are a number of brokers that offer zero commission and do not do payment for order flow. What I've asked staff is these payment for order flows and yes, rebates on the platforms, the stock exchanges and the like, is this the best to promote competition and efficiency? Is it the best to promote best execution? And you mentioned price improvement. Price improvement is being measured against an old measuring stick. The old measuring stick this thing called national best offer doesn't include what's in the dark markets, what's being internalized. It doesn't even include everything on the New York Stock Exchange or on NASDAQ. So I've asked, how can we look at this and look at this for investors and companies raising money both to be more competitive, transparent, and efficient?
Okay, thank you. We've seen a troubling trend within the Democratic Party of calling on financial regulators to enact their agenda when they realize they will never be able to pass it in Congress. We have seen lawmakers urge the banking regulators to force their regulated entities to de-bank legal industries that have fallen out of their political favor, such as oil and gas or the gun industry. We are now seeing similar calls coming to your agency, which is in charge of reviewing the disclosure of over 7,000 publicly traded companies and $100 trillion traded annually within our capital markets to expand your footprint into climate policy. So by calling on more stringent SG regime, we're trying to turn the many economists and financial experts at the SEC into environmental science that will force companies to adhere to a moving target of climate change goals coming from whichever party controls the White House. And as we create more uncertainty surrounding what information will be deemed material, I'm really concerned that everyday investors will ultimately be hurt by the activists who might be the loudest in the room but are not personally invested in some of these companies. So quickly, Chairman, how will you ensure that investors are not going to be harmed because activists pushing their agenda into a space where they do not care about any individual security?
I'll just say how I will be motivated and how I will ask the staff. It's about investors, and it's what Congress has asked us to do. Within our chalk lines, disclosure, full and fair disclosure is what Congress has asked us to do. And what we have now in the 2020s is increasing large numbers of investors want information about climate risk. So we can play a role at the SEC to bring some consistency, comparability, make sure those disclosures are decision useful, as earlier discussions in this committee today were, to make sure that folks aren't just green, it's saying they're green or sustainable and they're not. I think it can help companies and investors. And so to me, it's staying within what Congress has asked us to do.
I thank you for your testimony, and I yield my time back.
Thank you. The gentleman from Connecticut, Mr. Himes, who is the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and I have a question for the chairman, but I do want to take just a second to try to. I'm not a witness here, so I can probably use more blunt language than the chairman can use. My friends on the other side of the aisle are obsessed with this preservation of payment for order flow. I can say it more bluntly. Yes, when a broker uses payment for order flow, you do see price improvement, but you see price improvement off a really lousy price, a terrible price. And it is a truism in our capital markets that big institutional players get much better pricing, by the way, across the board on everything, than retail players do. And there are entire segments of the industry that are designed to sort of make profit out of that gap between the pricing that retail investors get, retail investors meaning individuals and others, and what institutional investors get. So what I would really love to see happen here, rather than seeing my friends on the other side of the aisle stand up for the preservation of a cynically misleading concept like price improvement, to actually dive into the question of why institutions get such better pricing on almost every product than individuals do. So I just want to make that point. But what I want to do with my remaining minutes, Chairman Gensler, it's great to see you again. I know I'm going to ask you to step a little bit outside of your comfort zone because you are more knowledgeable than almost all of us and probably all of the regulators on the issue of cryptocurrency regulation, something of interest to my subcommittee and Mr. Sherman's subcommittee. I want to turn over my remaining, I can't see the clock here, but 3.5 minutes or so to ask you to give us some guidance on the topic. And what I mean by that is there is legislation flowing around. Mr. Beyer has a piece of legislation that sort of departs from the traditional Howey construct of what would be a security. You have focused us on exchanges. Congress is demonstrating its ability to do very little these days. So I'm going to ask you to take the rest of my time to give us some guidance on how we should prioritize the legislation that we propose between exchanges, between the arduous work of defining who should regulate what type of cryptocurrency. Let me just turn over the time to you so that you can give us some guidance on how you think we might most fruitfully use our time to try to address those areas in which there's likely to be bad behavior.
I thank you. At 2 minutes and 20 seconds. I think that what we have here is a number of innovations, and with why I'm focused on the platforms, the trading platforms and the lending platforms, is because investors basically are giving ownership rights up. They transfer what's called a private key to the platform in most of them, and the platforms take custody, and those platforms then either trade on our behalf or lend to us and the like. And so I think such a tremendous amount of activity happens there, and it's a place that we could get better investor protection, customer protection alike. Even in the decentralized platforms or so-called DeFi platforms, there is a centralized protocol. And though they don't take custody in the same way, I think those are the places that we can get the maximum amount of public policy, whether it's for anti-money laundering, whether it's for tax compliance, whether it's for investor protection, which we so care about at the SEC. I do think that these platforms would like to say, oh, not us, we're regulated by 49 states under money laundering. But I think regulating these platforms like we regulate MoneyGram, right in there, that sort of like should have shine a spotlight that doesn't make much sense if we're talking about financial stability and we're talking about investor protection and the like.
And Chairman, regulating exchanges is not, and clearinghouses is not a foreign concept to us. Would you have us hew closely to analogies between the cryptocurrency exchanges and currently existing legacy exchanges, or do we really need to craft a whole new structure? You know, Coinbase is out there with an idea of setting up yet another regulator. Should we sort of use current existing regulations of exchanges as our basis for?
I mean, it will be for Congress to decide. And some were quoting my testimony of prior years. Congress could decide, but we have two really great market regulators. I was honored to chair each of them, and we have different authorities, derivatives, commodities, securities. I do think that we don't need another regulator. There is things that could be done to ensure that the smoothness of between the two agencies, and Russ Benham and I have been talking about that even if Congress doesn't act.
Thank you very much. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Madam Chair, and I appreciated your comments, Madam Chair, earlier in the hearing that you wanted to make sure we were adequately funding the Securities and Exchange Commission because they were the cop on the beat. I just want to note for the record that the chairwoman is for funding the police, and just appreciate that. Mr. Chairman, Chairman Gensler, thank you for appearing before us, and I appreciate our conversations about the importance of materiality with respect to climate risk disclosure. Earlier this year, you and the Commission issued a request for information on climate risk disclosure. A common theme among respondents to that RFI was the importance of maintaining this long-held materiality threshold. I agree with these suggestions. Materiality must be preserved. But I want to point out that materiality is determined by investors' need for that information to make informed capital allocation decisions. It is not in order to satisfy the leadership of some large institutional investors who are not necessarily aligned with retail investors in terms of their demand to name and shame companies or bias the market against certain politically unfavored industries. That is the difference between the standard of materiality versus what some large institutional investors demand. How do you plan to ensure that the SEC climate disclosure rule maintains the threshold of materiality and does not burden investors and issuers with an avalanche of extraneous information.
Well, I share your view that it's about investor demand, whether it's somebody buying 50 shares of stock or a fractional share even, or the large asset managers and pension fund managers that are investors as well. The pension fund managers, the asset managers are representing the rest of us, representing the public, and I share your point there. But
how well do you think they represent the rest of us, and how well do you think that proxy process actually accurately reflects the demands and the wishes and the desires of those retail investors?
Well, our job at the SEC is to make sure that it represents it through what's called the duty of care, the duty of loyalty, the 1940, the two laws passed back in 1940 that are really important, that investment managers are representing through their fiduciary duties, their public.
Yeah, and the reason why I asked that is because, as we discussed, as I talk to the investment advisors and broker dealers in my district, ESG is a very low priority of most retail investors. Retail investors care about returns. And what troubles me, and I want to ask you if you agree with this, the analysis that's a public record, that many of these ESG funds have fees that are 43% higher than non-ESG funds and cut into those retail investor returns. Does that trouble you?
Well, I think that two parts of that. One is I have asked staff to make sure that fund managers that are claiming to be green or sustainable or climate free or so, what stands behind that, that we should put out some rules on that. And if my fellow commissioners agree, we'll put that out to public comment. But a second thing is, how do we promote greater competition to bring down some of those fees in the fund management space? And I think that being clear on the naming and what it stands behind those names can also help in the competition on the fees themselves.
Well, as you move forward with your climate risk disclosure rulemaking, I just want to stress the importance of this materiality standard and what it actually is, because to rely solely on the comments that come in, I think, and just ignoring what the legal definition of materiality, I think, would miss the mark, because materiality is about investors' need, the actual need for that information to make informed capital allocation decisions. It's not just about large institutional investors' desire to name and shame politically incorrect companies. So let's I encourage the commission to look at materiality from the traditional conventional legal standard of what materiality actually means. In terms of liability protections, I do worry about the subjectivity of this, the concept of climate risk disclosures relying on subjective and untested metrics. Do you have plans to provide liability protections for issuers? What are your plans to ensure that these disclosures are preserved exclusively for informing investors and making their risk reward decisions, and not hijacked by enterprising trial lawyers for frivolous lawsuits?
Well, like all of our disclosures, they're based upon, as you say, what do investors want? What do they take into considerations? Or as the Supreme Court has said, what's if I remember, substantial likelihood that a reasonable investor finds significant in the mix of information for an investment decision. And that investment decision is really the important thing. And that's why we put it out to notice and comment. Investors get to weigh in.
Thank you. The gentleman from New York, the gentlewoman from New York, Ms. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Okay, thank you. I apologize. I had to chair a government oversight committee. I just got off of it. And Chairman Gensler, it's great to see you again. And I want to first ask you about cryptocurrency. You called it a highly speculative asset class. Do you think, and it's really a speculative investment, do you think it should be treated like a security, regulated like a security?
First, it's good to see you again. And I think it's always based on the facts and circumstances, but many of these projects, and there's 5,000 or 6,000 of them, but many of them are basically saying to the investing public, give us your money. And we have a small group of entrepreneurs and computer scientists that are going to build something. And based upon that, there's a hope and anticipation of reward or profit in the future. And Jay Clayton, my predecessor, said it in congressional testimony that most of these or many of these fit that definition.
And so do you think it should be regulated like a security?
Look, I think that I've asked projects to come in and talk to us because I can't say that it all fits together well, let's say in our transfer agent rules and some of the intricate underpinnings of our capital markets. But Congress painted with a broad brush to protect the public against fraud. And that's done through our securities laws when people are raising money from the public.
Okay, well, do you believe the SEC has all the authority that it needs to regulate this cryptocurrency if you should decide to do it? Or does Congress need to give you more authority to be able to regulate the cryptocurrency?
I thank you, and it's a question also the ranking member asked in a little bit different way earlier, is I think that our statutes are clear and Congress painted with a broad brush what is a security. But I think working with Congress, there are some gaps and there are some places that we can work, whether it's our relationship with our sibling agencies in the market regulatory space, but also as it relates to, for instance, what's come to be known stable value coins and how to think through that with the bank regulatory regime as well.
Well, I'd be happy to work with you in this area, and it is growing in prevalence in the district that I represent. Can you give the committee an update on your current thinking with regulation best interests, the so-called fiduciary rule, and whether you intend to take further action to strengthen this rulemaking?
I think that it's important that this rule, that it live up to its potential, that best interest really does mean best interest. So working with our examination staff, working with our Division of Corporate Finance, we've just hired an excellent person who's a senior advisor to me directly, is to ensure that the retail public gets the best. But I'm also asking the staff to consider how do we ensure that the brokers and the investment managers understand their duties under that rule and to ensure that they are actually, that best interest means best interest.
Well, okay, that sounds good. Now, lastly, this summer, the SEC approved NASDAQ's board diversity proposal, and they've implemented it. And earlier, with the support of the chairwoman and with Gregory Meeks and many others, we passed a bill that would call upon the SEC to disclose the diversity on boards, both for gender and for minorities and other information. And do you intend, you could do a lot in that area just on your own. It has passed the House. It is now in the Senate. Do you intend to do anything in the board diversity area?
I say this probably more than you'd like to hear. I've asked staff for recommendations in two areas related to this. One, with regard to the boards and board diversities, what recommendations that we as a commission meeting investor demand could do, but also more broadly the workforce, the entire workforce, or what we have come to call human capital disclosure. That's not just about part-time versus full-time and the pay rates and the like, but it's also about the diversity of the workforce as a whole. And on the earlier point, if I might just say on regulation best interest, look, if the rule doesn't work, ultimately, we're going to look to make sure that brokers ensure that the investing public truly gets best interest. So I want to make sure that I put a real comment on that.
Okay, thank you so much for your time, and I yield back.
Time has expired.
Thank you.
The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes. Mr. Hill is not.
Thank you, Madam. Thank you, Madam Chair. Appreciate that, and appreciate the hearing. And it's been a very educational hearing. Appreciate Mr. Gensler's responses to our members' questions, and following up on Mr. Barr and also Mr. Lukemeyer on the ESG industrial complex out there in the mutual fund asset management industry on advertising, branding, and analysis for ESG type funds. I think that is an important part of your testimony. I'm glad you referenced on it, both in the stock selection, the asset allocation.
Did you go mute?
Madam Chair, we cannot hear him.
So I don't know what happened there. It just kind of reverted to mute. I apologize.
Unmute.
It is unmute.
Okay.
Okay.
Thank you. We can hear you now.
Okay. Yep. I don't know what happened there. So I don't know what you heard and what you didn't hear.
I heard you compliment. Naming and ESG disclosure.
Yeah, good. Thank you for that. I appreciate Lukemeyer and Barr's bringing that subject up, and I don't know why it went on mute, as I say. So I'm glad that's being looked at, because I think truth in labeling there is important under the securities laws, that we're not misleading investors and we're providing a product that has real value, not overcharging for a product. When I look at a ESG fund that has a 0.9777% correlation with the S&P 500, it does make me question whether or not it's an ESG fund. Mr. Gensler, we talked when you were last before the committee about materiality, and you recognize that under 12b-20 that all public issuers have a duty to disclose every material aspect in their business on their financial statements. Is that right?
I'd have to look at provisions, but there is a requirement disclosure of material items.
Yeah. So, and you talked today about asking for the staff to look at both qualitative and quantitative issues. And on the quantitative issues, have you personally read the Madam Chair, this thing keeps muting without me touching the computer. So my irritation level is rising, but let me continue. That time I noticed it. So on the issue of quantitative, Mr. Gensler, have you read the task force disclosure report, the so-called Bloomberg report on the quantitative analysis on climate disclosure?
Yes, 2017.
Yeah.
Updates this year.
Yeah, good. Thank you for that. And in that, you note that they question the viability of Scope 1, Scope 2, Scope 3 emissions report and recommend other changes. And yet we have legislation demanding that use and mandating it. So you're asking the staff to look at all sources of emission type, not just Scope 1, Scope 2, Scope 3, I presume?
We are, and I hope that out to public comment from economic analysis.
And on the qualitative focus that you have when you try to have companies being described in their financial statements, qualitative factors about their climate resiliency and planning, how do you establish a liability standard for that? Is that the same as a material statement in the financial statements?
Well, we currently have financial statements other areas called like management analysis, risk and the like. So we already have disclosures. And so I think it would be something, but we'd see what happens after comment.
And one of the biggest challenges in the Financial Task Force report on climate disclosures is that it really is not possible to do make it comparable and accurate. There it goes again. Madam Chair, I'm going to yield back because this is too frustrating. And let me say again, I hope that we will have hearings in person and that we will stop these kind of online issues. You've heard members today talk about they can't have a fair and open interchange with witnesses. And when we have technology that simply mutes itself, we ought to all question any technology the committee is using. I yield back.
And if the gentleman will yield, frankly, all of Mr. Gensler's answers to you were in three-part echo
Excuse me.
on my end. I
The
doubt
gentleman
I'm
is
the
out
only
of
one
order.
that.
The gentleman is out of order. The gentleman from Illinois, Mr. Foster, who is also the chair of the Task Force on Artificial Intelligence, is now recognized for 5 minutes.
Thank you. Am I audible and visible here?
Yes, you are.
Well, all right. Well, thank you, Chair Gensler. And first, are you making contingency plans for dealing with the market chaos that may result if Senate Republicans force us into default?
I thank you for the question. I do want to say if Representative Hill would like to meet with me one-on-one or anything next week or in the next few days, I'd be glad to do that. Representative Huizenga, I thank you because I was hearing that echo as well. But on your substantive point, Congressman Foster, I think that as we get close to October 18th, as Secretary Yellen has put out, we need to understand that markets can get pretty, they can do things that we don't expect. That as mutual funds, as big banks, as hedge funds, as capital market participants start to anticipate what will Congress do, what will Congress not do, we will be in uncertain times in those last several days. And God willing, everything works out. But if we were to end up with a default, we will have a whole lot of uncertainty in major market participants, and the several days before, as we would move into that uncertainty as various
And yeah, I understand
participants react.
Right. So I understand you can't go into details now, but would you be willing to provide a confidential briefing to interested members of this committee on that scenario planning as it approaches, as the deadline approaches?
If we could follow up, I'd certainly want to work with the chair and probably with Secretary Yellen on that, because that's really where the main authorities and so forth are. But I would say that
well, you'll have to deal with the market.
I would not take lightly the uncertainties that will start to develop right around that time.
Now, from the point of view of the markets, is there any downside that you perceive if, in response to all of this brinkmanship, that the debt limit is just either outright repealed or through reconciliation simply raised to, I know Avogadro's number of dollars or some enormously high number that makes it irrelevant?
Well, however Congress addresses it would lower an uncertainty in the market. And by lowering uncertainty in market, you usually lower the cost of capital for those raising.
Okay, I'd just like to mention that in terms of an outright repeal, that I have a bill, the End the Threat of Default Act, that with over 50 House co-sponsors, which will simply do just that. And I invite and welcome all support from all corners on just getting rid of this silly rule that we made up for ourselves. I'd like to return once again to payment for order flow. As we all know, zero commission trading is not free because the retail customer often pays for it in terms of less than optimal order execution. The difficulty here, as I see it, is that there is no transparent market between trading platforms that includes good knowledge for investors of the quality and the total cost of order execution. So now there are two possible responses to this that I'd like your reactions on, that either the SEC or Congress could contemplate. The first is simply requiring that retail customers receive, along with their order confirmation, a summary of any fees or commissions, plus a summary of how the price they actually received compares to some fair estimate of the market price. For example, midpoint of the NBBO or some more sophisticated estimate. This would allow investors to see over time whether the total cost of trading on one platform was better or worse than another, and move their business to the platform that gave them the best total cost of trading. So that's the first suggestion I'd like to react to. A second possibility is simply to allow retail investors to request that their order and the platform that it was executed on be made public. Not the investor identity, but the platform identity. So at the time, also the time they placed the order and the price they received. This would allow third parties to, looking at this additional publicly available data, to give very high quality, high statistics evaluation of which platforms are giving the best total cost to retail investors in different market segments. So do you have any reactions to these? Are they implementable? Would they work as I would imagine they would in making a more transparent market?
if it would be all right, I'd like to suggest if your staff and some SEC staff could review this. I mean, I've really raised, how can we make these markets more efficient, more competitive? I think it would probably help to hear these ideas and sort them through outside of the hearing, just to see whether they're could be part of the
Well,
mix.
thank you. I'm out of time here, but I think transparency on total cost of trading should be our guide star on this. I
Thank you
yield back.
very much. The gentleman time has gone by. The gentleman from Minnesota, Mr. Elmer, is now recognized.
Thank you, Madam Chair. Can you hear me?
Yes, I can hear you.
Thank you. Chairman Gensler, thanks. Like everyone else, I want to thank you for appearing before the committee today. Appreciate your time. You've already covered this topic with some other members, but I want to go into it again. There are millions of Americans, as you know, who hold cryptocurrency. Specifically, over 55 million Americans are now engaged in this asset class. And the value of these cryptocurrencies, the value of the market, is approximately $2 trillion. You've been outspoken in that you think most cryptocurrencies on the market are securities. I couldn't disagree with you more thoroughly. I believe most cryptocurrencies are commodities or currency. But for the purpose of better understanding your perspective, I have several quick questions I'd like to run through during my time, and I'd appreciate quick responses to each question. Chair Gensler, let's say someone who issued a token agrees with you and thinks that their token is a security and they want to register it with the SEC. If they register it, can they trade it on the New York Stock Exchange, or could they trade it on NASDAQ?
It would somewhat depend on NASDAQ and New York Stock Exchange listing rules and how they register it, but there's multiple ways to register. If they registered and the New York Stock Exchange and NASDAQ said yes, that might facilitate it. Nobody's asked to do that as far as I understand.
Actually, the answer is no. Can a broker-dealer like Charles Schwab, another question, deal in a digital asset that has gone through SEC registration? In other words, would they be able to trade these digital asset securities and custody them?
Well, the custody is really the issue that you mentioned. We have not been able to sort through. There's a feature of crypto assets, which is that a private key transfers ownership. That's a feature, but it also creates challenges, or some would say it's both a feature and a bug of the custody of those crypto assets.
Again, I believe the answer is no. And I think earlier today you used the term stable value coins. There's no such thing. Value is a term that you put in there. They are stable coins. Chair Gensler, as you know, there are about 100 tokens with a $1 billion market cap. Let's say you deem one of these coins with a $1 billion market cap and tens of thousands of investors a security. What happens to those investors, sir?
Well, if the coin were to come in and to actually register, those investors get the benefit of our securities law. Right now, they don't have the benefit of that basic bargain that we protect people against fraud and manipulation in our capital markets, is they get full and fair disclosure. They're not getting that right now, and it's falling short, and people are going to get hurt.
Chair Gensler, actually, what will happen under that scenario is the value of the token will plummet, and retail investors, the very people you are supposed to protect, will not be able to trade in it. So I guess where I'm going to go with this, if there's no path for them to be traded anywhere, wouldn't investors be hurt by your enforcement actions? And what are you doing to solve this problem? What are you going to do?
What I've said publicly, and I mean this, is come in, work with us. If the rules that were written in other decades don't quite fit these digital investment contracts, and that's what many of these are. They're entrepreneurs, computer scientists that are raising money from the public, and the public is anticipating profits. And that's why Congress painted with a broad brush, and the investing public is relying on some group of entrepreneurs and computer scientists for their profits. And I'm glad to work with projects, work with Congress if you want to repeal the laws as they are, so that fewer people are protected against fraud in these markets.
And actually, Chair, I appreciate the answer. I don't know that the end, we still disagree on the securities aspect. I think the vast majority are currency or commodities. But this is why it's really important for the SEC to develop a framework that the crypto industry can operate in. Crypto is one of the highest performing asset classes in decades. Retail investors got into this space before institutional ones. And your job, the SEC's mandate, is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. When you make conclusory public statements and regulate through enforcement action, you jeopardize that mandate. I encourage everyone to take a look at my bipartisan bill, the Securities Clarity Act, which amends securities law with a new definition, the investment contract asset, so the SEC can work with issuers to swiftly determine when a token is offered as part of a securities contract and when it's not. Thank you again, Chair Gensler. Madam Chair, I yield back the balance of my time.
Thank you very much. And Mr. Gensler, I want you to know I appreciate your known expertise on cryptocurrency. With that, the gentlewoman from Iowa, Ms. Axney, who is also the Vice Chair of the Subcommittee on Housing, Community and Development, and Insurance, is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Chair Gensler, for being here. And thank you for your willingness to work on modernizing our corporate disclosures and, of course, looking at gamification on our trading platforms. I'm very focused on equity for the people who want to invest, and I appreciate you wanting to make sure that this is an opportunity for people across our country. But I want to dig into a different aspect of investor protection, and we're talking a lot about crypto today. Chairman, I want to know, can you briefly describe what the Securities Investor Protection Corporation does?
The Securities Investor Protection Corporation, or SIPC as it's sometimes known, was set up by Congress to protect the retail public that left money at a brokerage firm. And if that brokerage firm wasn't properly keeping that money segregated and protected and went bankrupt, in essence, the losses that might come. I don't mean to be a full expert, and I'm sure I've missed some part of it, but I think that's the basic bargain.
Okay, so basically when someone owns a security in their brokerage account, they have some protection if the broker goes bankrupt. Is that correct?
That the broker didn't take that security and give it to somebody else and the like. You still have market risk. We still have individuals have market risk if that SIPC didn't protect them, as I understand it.
Okay. But so I want to get to here is I don't think that applies to commodities or some other assets. Is that correct?
I certainly want to work with you on that, but I think that's correct.
Okay, so here's what I'm wondering. On some of our platforms, you can trade crypto literally right next to stocks for a token that isn't a security. What are the differences in protections for those investors? And we've got these up on our platforms. Do you think these investors on these platforms are likely to know that these protections are different? I'm hearing you say they're different. What's the difference between crypto and a stock? And do you think our folks even realize that when they come on as far as protections go?
I think you're right that the investing public is not getting protected right now, whether it's a digital asset that's a security, and many of them I think would pass, and while Representative Emmer and I had a little difference of view on that, would pass the Howey test in our securities, but some, as you say, a few might be commodities, and the Commodity Futures Trading Commission does have enforcement authorities around commodities, but as Commissioner Dawn Stump over there put out a paper recently and highlighted, they don't have regulatory authorities to write the rules of the road for those exchanges. So there are gaps there, both if they're a commodity and gaps if the exchanges are not registered as the New York Stock Exchange is registered.
Okay, so if we tie this back to the payment for order flow, on securities, the broker has to disclose, of course, how much they're paid and how those orders do. I think those disclosures aren't really sufficient and could be a lot better. But Chair Gensler, are there any such disclosures like this for crypto assets?
They're not required disclosures. Some of the brokers are trying to do some voluntary disclosures on things that are basically similar to the payment for order flow for crypto. But you're absolutely right; they're not doing so with the fullness as under our securities laws.
Well, something that caught my eye is just how much money some brokers are actually making from payment of just their crypto orders. If I'm correct, and I think this is true, Robinhood made more than half of their revenue from crypto in the second quarter. And yet we don't have the same disclosures about how that's earned for them and how their users might be doing these orders. So are there steps that the SEC can take to ensure that investors understand the protections they have when trading certain things, and information on that they might lose in certain areas on the platform? Or do you think that we should just make sure that anyone trading on those platforms has the same protections regardless of what they trade? And is disclosure just enough there, or do we need to be moving in a different direction?
I think the decisions Congress made long ago in the 1930s still stand true today, that the trading platforms, the exchanges of the day back then, had to come in and register and follow a set of rules, how they expose orders to each other, how they compete in the marketplace, how we protect people against front running, how we protect and promote markets through transparency. And so these platforms in a regulated space would be better for investors. And right now, we don't have that. And this is a highly speculative class of crypto tokens. I truly think people are, we're going to have hearings in the future, Madam Chair, probably on what went wrong here. And one of the things will be that these platforms didn't come in and get regulated with the appropriate authorities.
Thank you very much. The gentlelady's time has expired.
Thank you.
Georgia, Mr. Laudermilk is now recognized for 5 minutes. Mr. Laudermilk? If not, is Mr. Zeldin on the platform here? Let's see. Let's go to Mr. Mooney. Mr. Mooney? You're recognized for 5 minutes.
Okay, thank you very much. I appreciate the hearing and the opportunity to participate. Some important issues here that we are discussing. Chairman Gensler, I'd like to focus on the difference between what is considered guidance and what are considered rules. Changes in the rules and enforcement have large ramifications for market participants, both large and small. That's why it's important for investors to understand the difference between binding and non-binding directives from the SEC. Now, your predecessor, Chairman Clayton, was very clear on this issue. He released a statement in September of 2018, explicitly clarifying that, and I'll quote, all staff statements are non-binding and create no enforceable legal rights or obligations. So Chairman Gensler, will you commit to releasing a similar statement clarifying that all staff statements are non-binding?
Let me say it in my own words. I think that rules put out notice and comment to the public benefiting from economic analysis is what we're trying to do on many of these issues we've talked about today. Guidance can also be an important tool of an agency like the SEC, where market participants come in and say, there's a rule already. Can you please issue guidance that sort of is within that rule set, guidance about things. And we've been using this for many decades, whether it's in the accounting area, the auditing area, sometimes investor alerts, investment management. I think it is an important tool, but it's always within the rules that are already outstanding.
Okay, well, thank you for that answer. I encourage you to release a similar statement. I think doing so would provide clarity for investors who want to make sure they understand the rules they need to follow. Let me just give you an example. Whistleblower reforms that were adopted in 2020 codify existing procedures and improve the SEC's ability to provide awards that incentivize whistleblowers to step forward. In August, SEC, under your leadership, released a statement regarding the whistleblower rule. The SEC is able to revise and visit old rules and make changes, obviously through the notice and comment rulemaking process, as we just discussed. But in this case, it appears the Commission attempts to nullify an existing rule simply through a public statement. In response, SEC Commissioners Pierce and Roisman said that this action raised a dangerous precedent and, quote, reduces the certainty of law. So, close quotes. So, Chairman Gensler, in this case, it seems you adopted a significant change in policy simply through a commission statement. How is that not a way to avoid the notice and comment rulemaking process we just discussed?
The Whistleblower program is a really important program to help protect the markets. And what I ask staff to do is to look at our program and ensure that that whistleblower release of last year and the prior rule set are there things that we can do to ensure that whistleblowers, and it's such a critical program, have the not only the basic protections, but also as Congress laid out that they, when it's appropriate under the rules, get their awards, which range from 10 to 30%. And this has had to do really with the nature of the awards.
Okay, thank you, Chairman Gensler. It seems the whistleblower changes could lead to more and more changes of rules, attempts to change rules through simply making public statements. I worry the commission could set a precedent that public statements override established rulemaking, and that would cause our markets and investors to suffer. Notice and comment rulemaking forces regulators to take their time, listen to the public before finalizing regulations, and this comment period is important for getting rules right. So Chairman Gensler, I've heard you talk about the big ambitious plans you have for your tenure at the SEC. Remind you that Congress makes the laws, not the agencies. It's not within your power to create new policy and avoid the notice and comment rulemaking process. Thank you, Madam Chair, and I'll yield back the balance of my time.
Yeah, and I'll say I like notice and comment rulemaking. You hear from the public, the consultation is a constructive part of our agency's work.
Okay, thank you.
Thank you. The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you very much, Madam Chair. And Chairman Gensler, I thank you very much. I'm greatly appreciative of what you've been able to accomplish. I'm especially gratified that you have supported the Whistleblower Protection Reform Act of 2021, something that our office has been able to sponsor and to work with the General Counsel over at the SEC to strengthen. It means a lot to do this, and it means a lot also to have the level of cooperation that we've received from you. As you well know, and for the edification of others who might not know, this legislation expands upon what we did in the last Congress with the Whistleblower Protection Act. And that passed the full House with only 12 persons dissenting, 12 votes in opposition. This act revises the burden of proof. It authorizes compensatory damages for whistleblowers who are not fired, but who suffer some other forms of retaliation. And it protects them. It protects whistleblowers who report orally rather than do so in writing. I think it's a significant piece of legislation. I'm very grateful that Public Citizen has expressed its support for the legislation. If you can, Mr. Gensler, given that we have legislation, what do you think this legislation will do in terms of being helpful to the extent that other legislation that we did not get through could not accomplish?
Congressman, I look forward to looking at the details of the legislation, but I think in the direction that you've just outlined, the support we can give to whistleblowers, that they come forward. It's a hard thing to do. You're working maybe inside of a company, you're working inside of an asset manager or others to say, something's going on here that's amiss. And to come forward to talk to an agency like the SEC takes a fair bit of gumption, if I might say. And so anything that we could do to help support individuals to do that, it's a really important part of our oversight of markets. We, of course, get other sources of leads. We see things in the media. We have a terrific staff of examiners and enforcement and economists, but the whistleblower piece is an important piece of our overseeing the markets.
Well, thank you. I concur with you totally. And I would add something in addition. Knowing that whistleblowers are protected will also act as a deterrent within the corporate structure. I think that whistleblowers who have this added protection will come forward, but it's knowing that they can come forward with the added protection that I think will make a difference as well. Any comments on just the deterrent effect?
Well, I think it is an important deterrent effect. I remember when Senator Grassley was leading this back in the Dodd-Frank Act and working across the party lines. I mean, I think having whistleblowers be part of our examination and enforcement regime, and having a cop on the beat helps deter fraud, manipulation in our markets. It also helps companies, good faith actors, do their jobs better because it lowers uncertainty for investors.
Well, thank you. And finally, this, I'm inviting and requesting my colleagues, please support the legislation. This is a means by which Congress can weigh in and have a significant impact in a very positive way. So I'm grateful to you, Mr. Gensler, and I thank my colleagues who will support it, and look forward to working it through the House. Thank you, Madam Chair, for your support as well. Thank you.
Thank you very much. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Thank you, Madam Chair. Can you hear me now?
Yes.
Okay, thank you. Don't know what happened last time. Maybe the same thing that was happening to Mr. Hill, but thank you for this opportunity. Chairman Gensler, you testified to this committee in May. You and I discussed the consolidated audit trail. You assured me that most of the investors' personally identifiable information that was originally going to be collected in the CAT, including Social Security numbers and birth dates, will not be collected because the SEC was working on amending the CAT plan to remove that data. However, it appears that those changes still haven't been finalized, and unless they are, all of the PII will be collected. So the question is, when will the SEC finish the rulemaking to remove most of the PII from CAT?
If I could follow up after the hearing and sort of find out our exact dates, but I concur with you that the CAT, removing that data from the CAT is important. I know that it's on our docket. I know that I've met with the people in our trading and markets division that are working on that a number of times since you and I last spoke, but I'd have to follow up with an update as to which month we think we'll finalize that.
Well, I would appreciate that if you could follow up with us, because as you can see, and as we all can see, that cybersecurity is a critical issue right now with all of that's going on, and it's just going to continue to get worse. And I think we definitely have to protect the PI of investors. So if you will get back with us, I'd appreciate it. Another note, last year, the SEC finalized amendments to its rules regarding proxy voting and whistleblowers. However, shortly after you became the SEC chair, it appears you unilaterally decided that the SEC was not going to enforce those rules. Those decisions were now announced via a commission statement and not rulemaking. Two of the other commissioners noted that the SEC has a reputation as a steady regulatory hand because it has generally avoided playing seesaw with rules and is not reverse rulemaking when there is no new evidence to justify reopening them. So it appears that there may be some picking and choosing of which rules to enforce and which rules to ignore based on which ones you like and you don't like. Is this the direction that you're going? Is this the SEC's job to selectively enforce the rules based on personal preference, or how do you justify that?
So I think that at the heart of shareholder democracy was really an important feature of the many fund managers get advice from proxy advisors. And as you rightly said, there was a rule that was finalized last year. What I asked staff to do is to take a look at that, to take a close look at that and make any recommendations up. Again, the 5 commissioners through notice and comment, whether there should be any changes to that. So again, through the notice and comment period, and that's what I announced earlier this year that I asked them to do.
Okay. Well, finally, I'd like to note that President Obama's SEC Chair, Mary Jo White, opposed hijacking and security laws to push social and cultural issues. But based on the SEC's agenda, which includes issues like climate change and diversity, it appears you intend to do exactly those things. You often say investors want ESG disclosures, but in 2020, shareholders made 140 ESG proposals, but all but 6 of them failed. And the average vote was in favor, the only 30% was in favor. Only a relatively small number of activist investors want mandatory ESG disclosures. I hope you will avoid using securities disclosures to push left-wing political agenda and recognize that all companies are already required to disclose all material information to investors. And with that, Madam Chair, I yield back.
Thank you very much. The gentlewoman from Massachusetts, Ms. Presley, who is also the Vice Chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thank you, Madam Chair, for convening this hearing. Since the 2008 financial crisis, the private equity industry has exploded, tripling the amount they manage from $1.5 trillion to $4.5 trillion. Now, while banks are subject to certain SEC reporting requirements on their private assets, private equity firms do not have to provide that same level of transparency and are not subject to the same regulatory scrutiny, and they benefit from that. Chair Gensler, what tools is the SEC using to better monitor the activities that a lot of these non-banks, like private equity firms and hedge funds, are engaging in, considering they have great impacts on the economy and consumer-facing business?
I thank you, Representative Presley. Good to see you again, by the way. But in terms of private equity, you're right. It's our capital markets have the public markets, has the private markets, and then the intersection of the two. And I have asked staff to ensure that, to the best we can, that the arrangements between the general partners, the people managing those money, the investment managers and their investors, often their limited partners, those arrangements have the appropriate transparency, and that the investment managers are living up to their responsibilities, their duties, their contractual duties, but also their duties under the law in terms of representing those investors. I think that's really important. I've also asked staff whether we should update some of the data that we collect. It might not have been the center of your question, but on Form PF or on private fund in that regard.
Yes, that actually is the center of my question, which is, would you be expanding reporting requirements? That sounds like a yes. And if that's true, could you speak to timeline? How soon do you plan to take those steps?
In terms of timelines, again, I'd need to come back to you just because I sometimes can't remember every month and everything. But I've been meeting, even last week, I had some more meetings with staff on enhancements, potential enhancements to what we call Form PF or private fund, and also a separate project in terms of the responsibilities and obligations between the investment manager, GP, and the LP. But I'd have to come back and say when staff will serve up recommendations to our commission.
That's fine. And, we look forward to speaking further offline. Certainly just looking for bold and necessary action here as soon as possible. The affordable housing and eviction crises are racial and economic justice crises, and stable housing has been a matter of life or death for millions of people vulnerable to eviction during this pandemic. And 93% of the counties in the U.S., including in the district I represent, the Massachusetts 7th, a full-time minimum wage worker cannot afford a one-bedroom rental home. Nationwide, over 40% of Black and brown households spend more than a third of their income on rent. So in Massachusetts, a minimum wage worker must work 87 hours a week to afford a one-bedroom rental home. Meanwhile, private equity CEOs are living lavishly, pocketing billions of dollars in profit off the backs of these hardworking families struggling to keep a roof over their head. It has been well documented how private equity firms protected from the 2008 economic crisis. So after millions of people lost their homes to foreclosure, private equity firms bought residential properties at a deep discount, later raised rents, gouging tenants with fees, skimping on maintenance, and using aggressive collections and eviction strategies. Now, private equity landlords control at least 1 million apartment units and at least 250,000 single-family homes. And these aren't high-end homes. These are the entry-level homes and once affordable housing units that low-income families, disproportionately Black and brown families, occupy. This is why families can't afford to buy homes. When the economy is down, private equity buys up the neighborhood, guts it, and rents it for twice the price. So we have reason to be concerned the private equity industry will seek to profit off of the displacement of families during this global pandemic, no less. So, for example, Blackstone, world's largest private equity firm, has previously been called out by the UN for inflating rent, aggressively pursuing evictions, and fueling the global housing crisis. So, Chair Gensler, it doesn't have to be like this. Housing is a human right. I know our chairwoman agrees. I implore you to take action to help address these egregious behaviors and look forward to following up offline. Thank you, and I yield back.
Thank you so very much, Ms. Presley. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. And thank the ranking member McHenry and Chairman Gensler. Thank you for your time here today. In 2018, there was a New York Times article that discusses your views on blockchain and various cryptocurrencies. One of the cryptocurrencies discussed in the article was Ethereum. In the article, you say that Ether could have problems with securities laws because some of the first tokens were sold by the Ethereum Foundation before the network was actually functional. You go on to say that Ethereum could get off the hook from securities laws due to the fact that it developed into a decentralized network. You've repeatedly said that you believe initial coin offering tokens are securities, but right here it's sounding like you're acknowledging that Ether transitioned from what would have been a security into a commodity once the network was adequately decentralized. Can you clarify when a token is sufficiently decentralized to no longer be a security in your view?
I thank you for that. And digging back to an article from 3 years ago, but I was honored to study and research these issues at MIT. And what I was commenting on then was a process that the SEC was going forward on. And I think then head of corporate finance was talking about in that time frame. And so without going into any one token, what I think the core test is, and it's the test the Supreme Court has taken up numerous times with a broad brush, are you raising money from others and the investing public anticipating profits based upon the efforts in some collective group of individuals? That's central test. It's called the Howey test. There's other broad brushes with regard to this as well, as to when something is a note, called the Reeves test that Thurgood Marshall wrote a few decades ago. Fundamentally, the SEC is here to help protect the public from fraud, and that's why Congress painted with a broad brush.
Yeah, thanks for the clarification. And unfortunately, Congress didn't create the Howey test, the courts did. The same with the Reeves. And frankly, we're dependent on this patchwork of regulation by enforcement. Obviously, there are people that feel that a particular, token like Ether is treated differently than one like XRP, for example, is something, a matter that's before you right now, because of the same thing. Is it centralized or is it decentralized? Who has control? And I think that really gets to the issue. Congress really should clarify. We've had a bipartisan legislation called the Token Taxonomy Act drafted since 2018. We can't get a hearing on it. It would provide a bright line test that would apply a 1950s case law, Howey test, to modern digital assets and provide some of that clarity. But could you, generically speaking, talk about the shortcomings of enforcement actions or even threatened enforcement actions versus the need for clarity, maybe a rulemaking process that would establish a bright line? Because really what you referred to was, well, come talk to us in a one-on-one kind of third world way where every individual firm cuts their own deals. What the market really needs is clarity. Wouldn't that be better than threatened enforcement?
Well, I actually think that the securities laws are pretty clear on this, sir. And I think that firms should just come in and register. But what's happened over the last 4 or 5 years is they've either chosen not to, or they've stood up in Singapore or Malta or Hong Kong or other countries and offered their services indirectly through virtual private networks. Not all of them. Some of them are here in the US as well. And I think that our securities laws were written for a reason, to protect the public, the investing public.
Yeah, I think you're right. We should protect the public, but we need to do it with clarity. And frankly, we should do it in a way that doesn't destroy the market. I mean, you're talking about fintech being the leading innovation. America has led in market after market after market in field of technology, from the ag revolution, industrial, on up through the internet age. Why would we want to destroy the fintech revolution and push it outside the United States when we could foster it? I refer to your threatened enforcement action on yield products, for example. We should go through a rulemaking process, or frankly, Congress should act, which is why I'm drafting a bill that should be submitted shortly to clarify yield products and how they should be protected. The last thing I'd say is certainly not all stable coins should be considered securities. And I think you've referenced that, but I look forward to working with you and your office to provide clarity for our markets. And I yield.
Thank you. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Mr. Chairman, for being here. As you may know, I recently introduced the Registered Index Linked Annuities Act, or RILA. In recent years, there's been an increase in demand for RILAs, and these products, which provide the benefits of market exposure while simultaneously offering protections against extreme downward market volatility. I've heard from issuers of RILAs, including companies located in my district here in North Carolina, that the lack of a tailored form of registering these products has complicated their ability to market these products effectively. The Consumer Federation, American Council of Life Insurers, and others have endorsed the bill and has a strong bipartisan support from members of the committee. So I wanted to just flag this for you, like Senator Smith of Minnesota did in your last hearing. But I look forward to working with you to advance this legislation. So I'd be happy to hear any thoughts that you have on this matter.
No, I thank you. I thank Senator Smith for flagging it in the last hearing as well. And I think that index-linked annuities have come under the securities laws for quite some time. But what you're flagging is the forms that they fill. Could we find a way to basically change the forms they fill out at the SEC? Since the Senate hearing, I've actually asked the staff to consider some of the things that you and the senator have raised and to make some suggestions.
Well, wonderful. Thank you very much. So this committee has been advocating for the creation of the Office of Minority and Women Inclusion across financial regulators. These offices are to ensure internal staffing and procurement policies are inclusive and encourage all regulated entities to follow suit. So what are you and the OMWI office doing to increase participation?
Well, the OMWI office, headed by Pam Gibbs, it's a terrific ally internally in terms of trying to promote more minority and women inclusion in our hiring, in our promoting, in our senior ranks. I think the SEC, while we've made some progress, there's still a lot more progress to make in this regard as an agency. We're also beyond that, looking to see what we can do to, as we talked about earlier, in terms of various questions that we put out to the industry as to what they're doing in this same regard.
Okay. Have you considered making these assessments mandatory, or do you have any other inducement to encourage greater participation?
I think it would be good to have greater participation. I think I've asked counsel and so forth. I think while we are moving forward, and I hope to that staff will make recommendations, and my fellow commissioners will support some notice and comment on disclosures around diversity, disclosures around the board and the workforce diversity. I think until we were to do that, it would really be up to Congress to have participation, as you said, mandatory participation in some of these current just industry surveys.
Okay, great. Thank you very much. Madam Chair, I'm going to yield back.
And the gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chairman Gensler.
So China's been on a war path against cryptocurrencies, it seems, since 2013. And we've seen them implement bans on mining, initial coin offerings, cryptocurrency exchanges, and in their most recent move, an outright ban on cryptocurrencies themselves. So, Chairman, do you support what China has done, and is the SEC planning on implementing similar bans?
I'm familiar with a number of the things that you mentioned in terms of the People's Republic of China. I think our approach is really quite different, and it's a matter of how do we get this field within the investor and consumer protection that we have, and also working with bank regulators and others. How do we ensure that the Treasury Department has it within anti-money laundering, the tax compliance, and of course, the financial stability issues that stable coins could raise as well.
But no bans that you're interested in implementing via the SEC, as China has done, really to funnel everyone through their own digital currency.
No, I mean, that would be up to Congress. I mean, what we're really working with the authorities you've given us, and I've said this, I think that many of these tokens, it's based on the facts and circumstances, but many of these tokens do meet the tests of being an investment contract or a note or some other form of security, that we bring them within the investor protection remit of the SEC.
Thank you. We'll talk about innovation for a moment, which it's made the U.S. markets the envy of the entire world. The nature of the innovation that we have here, and referring back to Senate banking hearing that you were in, I think you stated before you're in your current role, you said innovation is what supports access, economic activity, and gives us, so many of us, better opportunities in life. End quote. So as the commission continues to review proposed changes, will you commit to balance any changes with the impact that it'll have on everyday investors?
I think that's at the core of our mission, our three-part mission, but also to balance the economics. That innovation, as I said then and will say now, does help increase our economy, increase access to capital. It's why I studied it. I was fascinated to study this at MIT, the intersection of finance and technology. But I think that new technologies rarely last long if they try to stay outside of whatever the public policy goals that a society lays out. And investor protection has worked for us for 90 years, and I think it's an important piece of whether cryptocurrency is going to survive or not, and meet its potential, whatever that potential might be.
Thank you. So you've said multiple times the SEC has a great deal of clarity on what exactly is a security. So given the SEC's approach to using enforcement as a way to regulate, you stated before the Agricultural Committee in 2018, quote, the SEC will need to decide if they might issue rules and interpretations specific to the crypto space, end quote. So now that you're leading the SEC, will you describe areas in which you plan to provide additional guidance or even enforcement?
Well, I want to say that I think the enforcement actions, I don't know, 6, 7 dozen enforcement actions over 4 or 5 years that the SEC has brought in this space, my predecessor, we continue to do, help to protect the public in terms of working with exchanges, platforms that come in to try to register. It's really to look at our rule set to ensure that we achieve the core of our rule set, but if there's some pieces of it that don't fit, I use things like transfer agent and others because they're easier for some to understand, that might not fit particularly with these new digital investment contracts.
Okay, just a few seconds left. Chairwoman, I yield back. Thank you, Chairman.
Thank you very much. The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Madam Chair. I thank you and I thank the ranking member for this committee hearing, and I especially thank our witness today, Chairman Gensler. Chairman Gensler, public companies, I believe, regularly fail in the potential cost of climate change and environmental exposure. Many companies, many public companies, fail to disclose what I believe are key material information surrounding corporate governance policies, such as employee and management diversity, or the lack thereof. In response, the House passed H.R. 1187, the Corporate Governance Improvement and Investor Protection Act. The bill included my ESG Disclosure Simplification Act of 2021, which requires public companies to annually disclose to shareholders certain environmental, social, and governance metrics and their connection to their long-term business strategy. Chairman Gensler, on March the 4th, the SEC announced the creation of the Climate and ESG Task Force in the Division of Enforcement. The task force focuses on developing initiatives to, quote, proactively identify ESG-related misconduct and, quote, identify any material gaps or misstatements in the issuer's disclosure of climate risks under existing rules. So, Chairman Gensler, can you provide the committee with an update on the task force findings and the scope of their investigations? And additionally, do you believe that all the public companies should be required to disclose relevant ESG concerns? I know that you talked a little bit about big and small companies. Could you elaborate a little more on that?
I thank you. I do think that investors have increasingly over the years asked for greater disclosures on climate risk and on the workforce. We have a separate project which might not fit into your question on cyber. The last time that the SEC put out guidance on this was in 2010, and the task force that was stood up in March of this year was to ensure that investors were getting the benefit not just of that 11-year-old guidance, but that companies were following their responsibilities under the disclosure regime. But I think that really that now's the time to put something out to the public. The public can weigh in. How can we as the SEC play a role to bring consistency, comparability, and yes, decision useful information around the physical and transition risks in climate that many of these companies are facing, and yes, around the workforce, including the diversity of that workforce. I think investors are asking for it, but again, we'll find out when we put things out to notice and comment. We'll see what people say.
Well, you say that investors are asking for it, and even some companies are already providing it. I mean, it's a different level, different things, but aren't they already doing that, some of these companies?
Yes, I thank you for saying that, because you're absolutely right. Of the top 500 companies by market cap, I think it's 80 to 85% are right now putting out climate risk disclosure on some voluntary basis. But that then it helps those companies if we bring some consistency and comparability to it. Imagine if companies, 400 or 500 of the leading companies in the U.S. were just putting out disclosure about their financials, but they were all deciding different ways to report their financials or a different way to report their executive compensation. So we have a role, and Congress gave us a role to try to standardize that and bring some comparability. And it helps the companies as well as the investors to bring some standardization.
I agree, and I think that's why the investors are asking for it, and I think that's why a lot of the large companies are giving it. I do want to ask with the last minute that I have, I know that a number of my colleagues are really hot on this crypto stuff. I have to tell you, people ask me all the time, one, what is crypto, and how does that help the dollar? How does that help the United States? How does that help anybody other than traffickers, narco traffickers, terrorists, or people trying to make a quick buck? How does it help us to have this cryptocurrency? I mean, I understand if the United States had a digital currency, I could see how it helped the dollar, but how does that help us, all of these cryptocurrencies?
Look, we have around the globe 180 fiat currencies, meaning 180 different countries have, but each country has one. We have the US dollar, and it happens to be the leading currency around the globe. It's unlikely that 5,000 or 6,000 private forms of currency are going to persist. It just, economic history tells us that's unlikely. So what a lot of these are not really currencies. They're not being used to buy a cup of coffee at Starbucks. What they are, most of them are investment vehicles, ways to raise money for entrepreneurs, and thus they should come in, they should be within the securities laws. The handful that might be competing with gold or silver as a digital speculative store of value, as gold is a speculative store of value over the centuries. but not many of them. Most of them are investment vehicles.
My
Thank
time
you
is,
very
thank you.
much. The gentleman's time has expired. The gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for today's call and today's hearing. Thank you, Mr. Chairman, for appearing today. If I could, I read your column that you wrote several weeks ago. Chinese firms need to open their books. I'm just going to ask you very broadly, what exactly are you saying? And of the 270 companies that you said may need to be prohibited from trading here by 2024, what are you seeing or what are you not seeing with those companies?
So there was a basic bargain entered into on a bipartisan basis about 20 years ago, the Sarbanes-Oxley Act. President Bush signed into law, and it said that to instill greater trust in our markets after the Enron and WorldCom fiascos, and that was about accounting fraud in that case, the company's auditors needed to open up their books and records to a new entity, the Public Company Accounting Oversight Board, and we at the SEC oversee the PCAOB. Nearly 20 years later, 50 plus jurisdictions have allowed that to happen, from Europe, from Asia, from Africa, from South America, North America. But 2 jurisdictions currently are not, China and Hong Kong. So Congress came back together last December and said, let's set a clock, a 3-year clock, and if this PCAOB can't see those records, in essence, there's 3 or 4 key things: that they have to select which companies they're inspecting, the PCAOB. Number 2, they have to see the work papers and see those work papers of the auditors, not redacted, not selected, but actually they need to be able to talk to the auditors to basically instill greater trust in the financials, in this case of these China-related issuers.
As a follow-up, and you did mention a specific number, 270 companies by 2024. Who are some of those companies?
Well, these are the companies that I call them China-related companies, because many are actually incorporated in the Cayman Islands and don't actually own anything directly related to these companies. But many of them are the large internet service providers in China, or internet companies similar to our large internet companies here that provide online retailing, online services. But there's also some insurance companies, some oil and gas companies that are related to China as well.
Let me, if I can't ask the same question a different way, you did identify a specific number, 270.
May I say that's just the number of companies right now that are China related, and based upon statistics that we can see from some outside services, NASDAQ and others, just list a whole list of companies, and I could certainly follow up and give you that. But we as an agency, the SEC, actually have a congressional mandate that each year in this 3-year clock that's ticking, we would publicly identify specific companies. So in early part of 2022, if China and Hong Kong are not yet compliant, then we would identify the specific names of companies and do this on a year later and a year later.
Do you anticipate that number could grow?
It could grow if there's more companies from China, or their affiliated companies in the Cayman Islands, because many of these are actually Cayman Island issuers that enter into arrangements called variable interest entity arrangements with China's companies. So it could grow, but we at the SEC put a pause on that until we could enhance the disclosures around these so-called VIE structures.
Lastly, Chairman, my remaining time, a couple of months ago, you stated before the investor advisory committee that you wanted your commission staff to work on new disclosure requirements for SPACs. Have you gotten those recommendations yet? And if not, when do you expect to receive those recommendations?
I've gotten them in terms of preliminary recommendations, but not a full rule that I can put in front of my fellow commissioners. But I think that we can try to address some of the disclosure issues around the SPACs that the retail public really, these are very costly vehicles for companies to raise money and for the retail investing public. And I think we can bring greater transparency and address some of the conflicts. But I could follow up as to which month I think I will be in front of our commission.
Thank you very much. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes. Mr. Torres?
Hello?
Mr. Torres? You're
Yes, I'm
recognized
here.
for 5 minutes.
Thank you, Madam Chair. It's a pleasure to see you, Mr. Chair. I have a question about neither admit nor deny policy. If you as a public regulator find that a company has engaged in wrongdoing and then take enforcement action accordingly, is it fair for the SEC to allow a company found to have engaged in wrongdoing or deny the wrongdoing in question? Is that fair and transparent and accountable?
I think you raise a really important point for agencies like our civil law enforcement agencies that with a group of limited resources, no matter what Congress gives us, it's always a limited set of resources on how to best protect the marketplace. And that's why I think it's so important and a remarkable enforcement division, I've said this, that we hold not only companies accountable, but individuals accountable, that we have a full rendition of the facts so that the public understands why we might enter into a settlement. I think what you've raised is usually in the context of settlements, and that we even use all the authorities in terms of individual bars and where appropriate on occasion to—
Mr. Chair, if I could just intervene, I'm asking if it's fair before we get to the resource question. Do you think that's fair? Do you think it's fair to have a policy of settling cases without requiring admissions of wrongdoing? Because I believe, and I suspect the majority of Americans that engage in wrongdoing as much, because there are reputational consequences that come from admissions of wrongdoing. But if you've defrauded your customers, I have a right to know, because if you allow them to settle and neither admit nor deny, then a company can easily say, I never did anything wrong. I never admitted to doing anything wrong. I just simply paid off the SEC to go away.
I think you'll find that I'm largely in agreement. It's the hard challenges of an agency like ours and other agencies. We're not the only federal regulatory agency that is faced with these challenges of resources. That what's really important is to have a real robust rendition of the facts, to use the authorities around individual bars. You're right that to go beyond fines, because fines all too often are viewed as a cost of doing business.
Are you just, and I want to move on to a new topic, but are you saying that—
I'm sorry, you're cutting out.
To rethink the policy of settling cases without— do you think that resource constraints make it impossible to rethink the policy of settling cases without requiring admissions of wrongdoing?
I think I heard most of what you said. I apologize because you were cutting out, but I do think that what's really critical is to use the resources that Congress gives us as best we can to lean in to ensure that we have a full rendition of the facts of the case, use our industry bars, and yes, from time to time, as you said, to consider whether to include that in settlement. And as you know, we also take many cases to litigation and into the courts where that's not the case, where in the courts you find different things. The court decides and opinions are written.
Mr. Gensler, I don't know whether Mr. Torres is still on the platform. It looks as if he dropped off. Mr. Torres, can you hear me? I think something has happened. I don't know if it's a technology problem, but
Hello?
I think he's coming back now. Mr. Torres, you may continue. You dropped out.
Chair Gensler, are you suggesting that resource constraints make it impossible to settle cases without requiring admissions of wrongdoing? I just want to be clear about your position.
I think that as we've had in this lively discussion, there's the challenges and trade-offs, and it's part of why sometimes we take cases directly into the court. So what you're highlighting, and I think we have a shared vision here, is to use all the tools that we have in our toolkit to ensure that market participants stay on the right side of the law. And that is at times taking things into the courts and litigating them fully. Occasionally, that's also settlements. It's ensuring when we do settlements that there's a full rendition of the facts, that we also use industry bars, that we, when appropriate, also have various serious undertakings by those.
Mr. Gensler, I just want to,
well.
I see my time's about to expire. I just want to quickly ask you about stable coins. Do you consider stable coins a systemic risk? Securities? Because obviously the nature of stable coins will determine the nature of regulation. So what is your conception of stable coins?
Right.
Or is it securities or a systemic risk?
So I would say this, we already have, oops, the gavel's coming down. But
is it a systemic risk, yes or no? Yes or no?
I think the $125 billion of stable coins we have right now are like the poker chips at a casino. And I think they create risk in the system that we have digital lending, crypto trading, that yes, I do think that if this continues to grow, and it's grown about tenfold in the last year, it can present those systemic wide risks.
Thank you.
Thank you, Madam Chair.
Has expired. The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Chairman Gensler, for your time today. I also want to thank you for our time last week. I thought it was a very good conversation. As I mentioned in our call, I am extremely excited about the opportunities from emerging blockchain technology for our economy and opening up finance opportunities to the unbanked and underbanked. Additionally, when I look at those who have done the best financially in the crypto space, it seems to be a much more diverse set of players, which is completely unlike the traditional finance world that is almost exclusively dominated by those who happen to have attended the best schools and have the right pedigrees. This tells me that crypto is enabling wealth creation opportunities in a way that the traditional finance world simply has not been able to accomplish in many respects. Recently, we have seen a boom in DeFi products that gives individuals the power to lend, borrow, and earn interest through the Ethereum platform and somewhat on Solana that far exceed the 0% rates that U.S. Treasuries provide. I've been speaking with multiple companies in the space, and the common theme in these discussions is that they want to come in and describe their product to the SEC. However, they are concerned these meetings could lead to a potential enforcement action. They also see some of the comments similar to the ones you just made about many of these products, in particular stable coins, being the poker chip at a casino, as unnecessarily demeaning and suggesting there is a presumption of guilt on the part of the SEC. And so this sort of friendly open door conversation is not something that they believe they're experiencing. So I guess my first question, well, first I want to start on stable coins. It seems to me that when you're thinking about stable coins and whether they're a risk or not, a lot of that falls back on the quality of the reserves, and what ultimately backs up the stable coin should be determinative of whether it's a true stable coin or it's a junk coin. If you could, well, one, would you disagree with that characterization? And if so, please explain why, if we agreed on what constitutes a high quality set of reserves, why that would in effect somehow necessitate calling them a poker chip at a casino.
Let me just comment on that last point. We have regulation in many states of the land. Nevada started, New Jersey, but my home state of Maryland had to take this up some 2 decades ago, regulating casinos. And it ensured for certain safety and protection for the public. So I think that we found our way through that set of public policy issues, and we can find our way through this as well.
If I could really quickly
in terms of
on the
stable
casino
coins,
route. Real quickly, Chairman. So there is a key difference between a casino and a DeFi product. In a casino, you are guaranteed to lose 100% of the time. If you play long enough, you will lose. The odds are against you unless you're cheating. That is not true in crypto. It's not true on blockchain technology. But I'll let you proceed.
So in terms of a number of these platforms, you've attempted me in here. A number of these platforms are saying, "Come hither, and we will give you a return on your crypto if you leave it with us, and we'll give you staking returns or lending returns." And often they are, as you said, above what you can get in a money market fund or you can get with investment advisors. So within a transparent way, how are people sort of advertising 4% returns, 7% returns, sometimes up to 21% returns on these crypto platforms? So I think that's what we're trying to do, is to ensure that the public's not defrauded and what stands behind those claims. In terms of stable coins, I do concur with you that there are different types of coins. Wrapping something computer graphically around fiat money could be different. It could be directly around deposits at a bank, or on the other end of the spectrum, it could look a lot like a money market fund, because it could be like our money market funds around treasuries, commercial paper, certificates of deposit, and so forth. So it really depends on what the underlying assets are. But I do think, as you just said, that there's a way to ensure the reserves are tightly and appropriately tied to the banking system, but that might raise other issues, because we already have digital money in this country. We have for decades had digital money. It's called digital bank deposits. And so now the question is, what is stable coins giving you more if they're not just giving you a way to avert tax collection, tax compliance, and anti-money laundering? And I do think a lot of these stable coins are, excuse me for saying it, they grew up over the last 8 years inside of trading platforms around the globe to avert anti-money laundering laws and tax compliance.
I see my time is up. With that, I yield.
Thank you. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
I thank you, Madam Chair. And Chair Gensler, it is a pleasure to have you here before us. Thanks for providing testimony to the committee and to discuss the priorities, the mission, and the needs of SEC. So to take a bridge from that conversation around resources and your budget request, I wanted to give you an opportunity to talk about your budget request. SEC is requesting a little more than $2 billion in appropriations for fiscal year 2023, a little more than 8% increase compared to 2022. In fact, the final statement in your written testimony says, as more Americans are accessing the capital markets, we need to be sure that the Commission has the resources to protect them. I agree with you completely. How we budget reveals our priorities. With the amount of funds in your budget request, will that offset the staffing level decreases that SEC has suffered since 2016, which I believe your agency has reported at about 4% decrease? And what key areas of staffing are needed with this budget request? And I guess one final piece of that, I believe it is a deficit neutral budgeting statement in terms of SEC budgeting. If you could address that.
Yeah, thank you for that. Yes, to go in reverse order. We are, because under congressional authorities, the SEC sets an annual fee on various securities transactions. And so from the point of view of the U.S. taxpayer, it's paid for, in essence, by the market itself and the market transactions. In terms of levels of staffing, we did work with the Office of Management and Budget and on that 2023 request, but it doesn't quite get us. We had shrunk several hundred people, or 200 plus people since 2016, and this gets us just below where we were in 2016. I would have preferred to have been asked to take on an agency that had grown 4 or 5% and not shrunk 4 or 5%. And this doesn't quite get us above the where we were 5 years ago. And this is a market that's continuing to grow. The last thing I'd say is technology. we spend, give or take, $350 million a year on technology at the SEC, which is probably what some of the big banks spend in a couple of weeks. I mean, if you just take the numbers, and that's one systemically important bank or something like that. Certainly, most of them spend more than that in a month. And so it's just the nature of congressional appropriations. We are where we are. We've asked for a bit more, but it doesn't quite get us to where we'd like to be.
Can you speak to the focus at SEC as you, I hope, staff up, a focus on diversity across the board at all levels of SEC?
It's a really important focus in terms of recruiting people, but also promoting into the senior ranks. I've tried to do my best with the handful of people that we've hired, whether in my front office or as division directors, but also to work with our Office of Minority and Women Inclusion, work with our senior officers, that every time that we have a possibility of promotion, to really look across the agency. We're advertising externally and internally, and I think that's important to allow people to have an opportunity for those senior roles as well.
That's terrific. And finally, my final question, we've spoken a lot about the mission of investor protection. Finally, do you recommend, with the notion in the spirit of the ultimate investor protection, as we see us inching toward this potential catastrophe in reaching the debt ceiling, do you recommend a lifting or elimination of the debt ceiling?
Well, of course, I have to leave some of that to Congress and the executive branch, but I would say this, as the chairwoman asked me earlier in this hearing. I think as we get within a couple days, if I should say, and hopefully we don't, but if we get to a couple days before that fateful October 18th, my God, it's my twin brothers and my birthday. What a fateful October 18th that would be. But as we get closer to that, I think we will start to see fraying in the marketplace. And there's great uncertainties if we actually defaulted on our debt, terrific uncertainties, because treasuries are the base upon which the rest of our capital markets stand. It's like it's saying, let's test the foundation of a house, and let's make sure the foundation of the house defaults. The rest of the house is going to have problems.
Well, I wish you and your brother a happy birthday, free of this burden. And it's irresponsible that any member of Congress would want to walk us toward that brink. And I yield back.
Thank you very much. The gentlewoman's time has expired. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member McHenry, and thank you, Chair Gensler, for your testimony and participation in today's hearing. I want to welcome you again to the committee and want to once again remind you that historically, the SEC has administered the federal securities laws in a bipartisan fashion, and it is my hope that you continue that tradition, as I believe our securities laws are not where we should be holding debates about climate change or things like racial inequality. Obviously, as we reviewed market events in January, we restarted the conversation regarding payment for order flow. Now, I'm not necessarily in favor of banning payment for order flow like the legislation my Democratic colleagues have proposed, and you have said is, quote, on the table, unquote, especially without the proper due diligence of studying its benefits and costs. I know we have talked about payment for order flow a lot in this hearing, but I feel like we haven't gotten a lot of answers. Chairman Gensler, in the previous hearing, you agreed with me that transparency is key and said that your staff would be examining payment for order flow. That was in May. In your testimony and throughout this hearing, you have said that you have asked for staff recommendations over the last 5 months. How far have they gotten in that examination, and what were their findings, and when can we expect a report from you and the SEC on those findings?
So if I could, I thank you for that. If I can separate out in terms of the January events, the staff of the trading market staff and the Division of Economic and Risk Analysis has put together a report, shared it with the 5 commissioners, and through that commission discussion, I would anticipate we'll have that report out shortly. Again, there's 5 of us, and so there's a little bit of moving around. In terms of the broader public policy issues, because that's just a report. In terms of the public policy, I still share the view. I think this is driven by economics. What's best to make our markets most efficient, and whether it's, as you mentioned, payment for order flow, or other parts of the stock market. What's critical, I think, is a couple principles. One is order competition, having my order compete with yours. And see, most people don't realize if you go onto a trading app or on your computer and you put a market order in, it's not likely. In fact, it's highly unlikely that it goes to the New York Stock Exchange or NASDAQ or a lit stock exchange. It's being bought by an internalizer and a handful of internalizers. And so we're really looking, is that the best way to instill competition in this market and efficiency, and to address some of the inherent conflicts that can be in this system?
In a hearing earlier this year, I asked one of our witnesses what reforms he thought the SEC could implement with respect to payment for order flow to increase transparency for retail investors, and he suggested more granular 606 reports, specifically doing more to provide better public transparency of best execution. Is your staff looking into additional changes to these reports? And if so, what changes?
Well, so I'll use terms that I used earlier. That's on the table as well, sir. But I think that the question is whether disclosure alone, by enhancing the disclosure around payment for order flow, really will address it. United Kingdom, Canada, Australia, all have banned payment for order flow. I know we have different markets, different systems. We even have letters that we've gotten over the years, dating back over the last 20 years, articulating why it's not good for our system. So I've really asked staff to consider that, but also to consider it only in the context of the entire market structure in terms of the exchanges and what they're paying when what's called rebates. How do we look at what's called the national best bid offer? Because that's often what's used to measure price improvement. So is it the right measuring stick or measuring rod to look at?
See, my time is short. In a challenging global economy, the strength of our capital markets is vital to long-term economic growth. Yet regulatory burdens and increasing amounts of red tape prevent small business from thriving and stifles American innovation. The advances we have seen over the past decade in technology have improved the way Americans and our businesses perform financial activities. Due to these investments, we are seeing more investors who have historically been left out active in the markets. We should not stand in their way. With that, Madam Chair, I yield back. Thank you, Chairman Gensler.
Thank you very much. The gentlewoman from New York, Ms. Ocasio-Cortez, is now recognized for 5 minutes.
Thank you, Madam Chair, for hosting this hearing, and thank you, Chair Gensler, for joining us today. I want to take a few minutes to discuss stock buybacks. Now, during the pandemic, I and many others on this committee and beyond introduced pieces of legislation either banning the practice of stock buybacks or regulating them in a broad kind of spectrum of possibility. And one of the issues that I had brought up was actually banning the practice of stock buybacks for any corporation receiving public assistance, essentially getting bailed out, and while also mandating workers be granted an equity stake, or the public being granted an equity stake in any of those kinds of public buy-ins to those companies. Now, I want to dig into this issue a little bit more. Now, for folks, I think, following at home, stock buybacks in general is this practice. Would you say it's fair to describe stock buybacks as the practice of a company using its profit or margin to purchase shares of its own stock, as opposed to other uses of its margin, like investing in raising wages, research and development, etc.?
If I could just broaden it out, I think the companies that use dividends and stock buybacks both have made some decision to send money out of the company to their shareholders or buy back their shares rather than investing. I think it's usually a two-step process. One decision is whether to invest, as you say, more in the factories, the innovation and so forth, or send it out to shareholders, and then usually a second decision whether to do it through dividends or share buybacks.
Thank you so much, Chair Gensler. And what we saw during the pandemic was that some of these same corporations that spent about $6.3 trillion on stock buybacks between 2010 and 2019 also denied their workers hazard pay, personal protective equipment, claiming that it was too expensive. Now, on top of that, production of medical equipment that was necessary during the pandemic was also delayed due to many years of underinvestment, in part in research and development from these companies that were using some of their funds to purchase their own stock instead. Would you agree that stock buybacks make no real contribution to the productive capabilities of a firm?
Well, again, I mean, both dividends and stock buybacks are a way that management and boards send money out of the company to shareholders. And so there is, as you say, some trade-offs between that and what they're investing. Our role at the SEC is to make sure that we bring transparency to these considerations. Of course, those of you in Congress, might debate whether to change those rules, but we try to bring transparency and ensure that there's not fraud or buybacks in circumstances where the company has insider information and the like.
Thank you. Now, President Reagan's SEC adopted Rule 10b-18, which limits stock buybacks under certain volume, broker, and timing conditions, though the amount that a large company can spend on buybacks on a daily basis under this rule is often in the hundreds of millions of dollars. Now, conforming to these conditions allows a company entry to a quote-unquote safe harbor. Does the SEC actively monitor whether corporate buyback activity remains within its safe harbor?
So you raise a good point. It relates to earlier debates about resources, but we try to use our resources across the agency to ensure for compliance with the laws. I've asked staff, in terms of stock buybacks, could we also use some authorities that were put in place under Dodd-Frank about the disclosures?
So I apologize, Chair Gensler, but does that mean, is that a no due to resource issues? That the SEC does not actively monitor?
We pursue. I want to say it's more nuanced than that. We pursue and we use the enforcement and examination and corporate finance staff to look at what we can. But there's 7,000 public companies in the U.S.
Understood. Would the SEC consider rescinding Rule 10b-18 and issuing new guidance that clearly states that corporations may be held liable for stock buybacks that constitute potential market manipulation?
So I think it's clear right now that if it's market manipulation, you can be held accountable. What I've asked the staff to do is to look more broadly, because we have new authorities under Dodd-Frank to actually get more transparency in this area as well.
Great. Thank you very much.
Thank you. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chair Gensler, for taking your time to be with our committee today. Back in May, the Securities and Exchange Commission's Small Business Capital Formation Advisory Committee made 2 specific recommendations to you, not simply to stimulate capital formation for new small businesses, but also to make it easier for women and minority-founded enterprises to raise capital for their entrepreneurial endeavors. The advisory committee noted that traditional institutional investors are known for pattern matching, or making investment decisions that replicate patterns of who a successful entrepreneur has looked like in the past. But unfortunately, this often locks out women and minorities who are often different from traditionally successful entrepreneurs. The changes recommended by the advisory committee were, number 1, increasing the cap on the aggregate amount of capital contributions and uncalled committed capital from $10 million to $150 million. And number 2, increasing the allowable number of investors or beneficial owners from 250 to 600 for qualifying venture capital funds. Following their recommendations, I introduced the Improving Capital Allocation for Newcomers Act of 2021, or the ICANN Act, which would codify these recommendations. We all know capital is the lifeblood of all businesses, but especially so for small businesses in their formative stages. So, Chairman Gensler, would you support codifying these recommendations, increasing the aggregate amount of capital allowed from 10 million to 150 million, and increasing the allowable number of investors from 250 to 600 for qualified venture capital funds that your advisory committee made?
So I would want to take a look at your legislation, sir, and try to work with you on it. I think that there's a balancing act in all of these as to how do we ensure that investors get the appropriate disclosure, whether it be in a venture capital fund or otherwise. And so it's important that that investors get that disclosure. But I look forward to working with you and look at your legislation more specifically.
I really appreciate that, and I look forward to working with you as well. We'll get you a copy here after this hearing. I want to end my time by responding to some of the comments that Madam Chair made in her opening statement today regarding the debt limit. She said we are insisting on a debt default, the Republicans are insisting on a debt default, and that we are playing a dangerous game of chicken. Two things are obvious here. No one wants a default. And if there's a game of chicken going on, it takes two to tango. Yesterday, President Biden said Republicans' stance refusing to raise the debt limit for him was hypocritical, dangerous, and this really got me, disgraceful. I find that statement the height of hypocrisy since then Senator Biden voted against raising the debt ceiling 3 times during George W. Bush administration in 2003, 2004, and 2006. 3 separate times. Republicans' position on raising the debt ceiling has been clear for months now. If Democrats want to spend trillions of dollars on their reckless tax and spending spree in a partisan manner, then they should have to raise the debt ceiling in a partisan manner as well. They have completely rejected us as governing partners since President Biden was sworn in. Until now, when they want to raise the debt ceiling. This is not how that works. Congress has raised the debt ceiling through reconciliation before. It can do it again. Just last week, the Senate parliamentarian laid out the process for doing so. Republicans will not be complicit in the Democrat sprint towards socialism in America. If we default in a few weeks, there will be no one to blame except the unified Democratic government in the White House and Congress. They control both houses of Congress and the executive branch. They will own this default if it happens, but I don't think it will. I do believe that the Democrats will come to their senses and use reconciliation to get this done. The only reason Democrats in Congress have already gone down the path of reconciliation, or have not already gone down the path of reconciliation, is because they know it will be a tough vote, since when using reconciliation, they will have to specify the exact dollar amount they want to raise the limit instead of simply suspending the debt limit for a period of time. Admittedly, that is a tough vote. No one wants to be on the record voting to raise the debt limit by several $1 trillion. And if my Democrat friends are going to pass this reckless tax and spending spree, that is exactly what they will have to do. I just hope my friends figure out exactly how much money they're going to spend on this thing soon, because I would hate for them to not raise the debt limit high enough and find themselves in the same position again in a matter of months when the bill comes due. With that, Madam Chair, I yield back. Thank you.
Thank you very much. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes.
Thank you, Madam Chair, and good afternoon, Chairman Gensler. Thank you for joining us. I represent a working class district in Chicago. Many of my neighbors lost their jobs during the COVID-19 pandemic, and many lost their businesses. But so far, we've avoided a financial crisis. That wasn't luck. That comes from the robust protections that Congress put on our banking system with Dodd-Frank and active intervention from our regulators. But we aren't safe yet. People in my neighborhood still worry about losing their homes, but the stock market and cryptocurrency markets are swinging up and down. You can see the instability. For instance, with respect to stablecoins, they're valued at nearly 70 billion, but they are bigger than that. They make up a tremendous part of the market for cryptocurrency. And the same investors who buy cryptocurrency are in the stock market, which affects our whole economy. We know the risks are there, and it's up to us to protect our markets, because My constituents can't afford another financial crisis. Chair Gensler, are you worried that stablecoins might pose a systemic risk to our economy? And is that something that the FSOC is looking into?
I thank you. I think that the Financial Stability Oversight Council, my colleague, my good friend, Secretary Yellen is leading this. We are looking at stable coins right now in terms of a number of matters. You asked about could it impinge upon financial stability. We're also looking at how it relates to guarding against illicit activity and investor protection. And I think there is issues in all three buckets, not just financial stability. It's about $125 billion of these coins right now. There's 4 or 5 big ones. And those coins are intertwined in a crypto trading system where while they are only about 6 or 7% of the market value of cryptocurrencies, they represent probably 3/4 or 80% of all the transactions in crypto are versus a stable coin. That's why I've said it's like the poker chip at the gaming tables, but they're used to buy and lend other cryptocurrencies. The other thing, it's grown about tenfold, roughly tenfold in the last 15 months. And so you could see where it could start to undermine things if it continues to grow. Undermine traditional banking payment systems if it's not brought inside of the remit of banking, and also undermine some of that which we do in investor protection at the CFTC and SEC.
Thank you for that. And as we've seen to the south of us in El Salvador, President Bukele's announcement that he would make Bitcoin a national currency. Last month, thousands of people took to the streets of the capital to protest this move as dangerous and unconstitutional. Given the volatility that we've seen in Bitcoin prices, it seems to me like a risky move. Mr. Gensler, you've seen how much the price of Bitcoin moves in response to announcements from U.S. regulators. Do you think speculation and regulatory arbitrage are important drivers in the price of Bitcoins?
Well, Bitcoin, which was the first cryptocurrency based upon Satoshi Nakamoto's paper in the middle of the economic crisis in 2008, is a highly speculative asset, but it is a store of value that people wish to invest in, as some would invest in gold since antiquity. But I think you're also right that it is used, not just Bitcoin, but other cryptocurrencies, stable coins, to try to, as you said, arbitrage between regulatory regimes. I think it's why stable coins and cryptocurrencies became intertwined to, frankly, to avoid another digital type of money, and it's called the US dollar. The US dollar, I mean, is a digital form of money. We already have digital money. But this has been used in part for these other reasons. So it's a speculative store of value, yes, Bitcoin, you're asking. Many of these 5,000 or 6,000 other projects are also a way to raise money, and they are digital investment contracts, depending upon the facts and circumstances. And they're a way to arbitrage some of our rules.
Thank you, Mr. Chairman. Madam Chair, I yield back.
Thank you very much. The gentleman from New Jersey, Mr. Goppenheimer, who is also the vice chair of the subcommittee, National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you, Mr. Gensler, for being here today. We heard Federal Reserve Chairman Jerome Powell testify how the Fed was not seeking to ban stablecoins and other cryptocurrencies, even as they continue to examine the potential creation of a central bank digital currency. You've previously stated how stablecoins could be treated as securities and criticized them as poker chips, as you've referred to them several times today. Given your skepticism, how do you envision stablecoins being integrated into the broader U.S. financial system, particularly the digital payment space, and what do you feel should be the SEC's role in this process?
So it's good to see you, Congressman, again. Thank you. Look, even poker chips in a regulated environment are a good thing. Poker chips at a casino do serve a purpose to provides greater transparency at the gaming table, and they even lower the security risk about money being stolen at the casino. So I just want to caution, I'm saying how it's economically being used. I think that working with our colleagues across the President's Working Group, we're going to come up with some recommendations. But I do think, to the extent that a stable coin is directly tied to deposits, cash in a bank, and it's one-to-one, and it's got clear and clean reserves, that type of digital payment system, if that's all it is, then we can put a banking remit around it. I think that many of these at the other end of the spectrum might be investing in securities, and they start to take on characteristics like money market funds or others. And we've had some challenges, particularly since money markets are larger, about instability in money markets when there's kind of stress periods and runs on money markets during periods of stress. We wouldn't want to move that type of instability into these stable coins. And then lastly, yes, I think they've been used inside the trading platforms and lending platforms, crypto this is, they've been used in part to avert laws around tax compliance and illicit activity.
Thank you, Chairman. Separately, I've opposed the concept of a financial transaction tax in the past, particularly because of the potential negative impacts on the U.S. as a leader in the financial industry, including many businesses that are in my district. In March of this year, you stated in your written follow-up to the Senate Banking Committee that you have not previously studied any current proposals for imposing a financial transaction tax. I'd just like to ask if you have any follow-up to that statement, and also inquire if you have any thoughts on how a financial transaction tax might negatively impact the broader U.S. economy and our leadership in this space.
I haven't had occasion to study more. I mean, as you probably are aware, we're an agency about $2 billion a year that is funded by securities fees, transaction fees, and at that level, the $2 billion to fund the agency, I think it's worked smoothly in the markets. But I haven't studied anything that would be, of course, the debates have been about something much larger than that.
Well, I'd be eager to hear back from you when you spend some time with it. And it's always good to see you. Thank you for your leadership, Mr. Chairman.
Well, thank you. I hope your family and you are staying well in these times.
You too, sir. Thank you. Take care. I yield back.
Thank you very much. And now the gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Chairwoman. I'm so sorry I had to do this in the car like this. Thank you so much for holding this important hearing. As you know, I've been incredibly passionate about accountability, and especially Chairman Gensler. I'm very alarmed, as you all know, about the recent disclosures, if you haven't watched some of my comments, regarding several Federal Reserve officials who made transactions during the pandemic that I believe violated the Fed's ethics guidelines and may have violated the law. As you know, February 2020, Vice Chair Clara traded between 1 million to 5 million out of a bond fund into stock funds. The next day, as you may know, Chairman, the next day, Chair Powell issued a statement on the pandemic that was, quote, the first step in a wide-ranging central bank rescue that would ultimately push up stock prices. So we also learned that Robert Kaplan, the president of Dallas Fed, Eric Rosengren, president of Boston Fed, made major transactions involving securities and markets supported by the Fed during COVID. The Fed's own ethic guidelines state that the officials should avoid, quote, even an appearance, Chairman, even an appearance of conflict between the personal interest, the interest of the system, and the public interest. So I want to ask you, these trades don't have the appearance of a conflict. In my opinion, they are a conflict of interest. So Chair Gensler, are you aware of these 3 instances? And is the SEC looking into these transactions as potential inside trading?
Congresswoman, I hope if I could speak to this in the generic because it wouldn't be appropriate to speak about any individual circumstance. But we at the SEC have a broad remit, and it's one that you've put in place in Congress, that we would pursue what's known as trading on material non-public information, whether people are at a company or even if people are within other agencies. And we've done so in the past. We will continue to do so in the future to help protect the integrity of the markets.
So Chairman, I'm curious, so do you need like an official letter from me to ask you to look into something? Like, what did you need? Do you need from me or from others? I know Senator Warren has been very public about some of the concerns, because I'm telling you, the American people are pretty very angry of anything where, again, they're in a position of public trust and folks are using that position for their own personal interest. So, Chairman, tell me what I need to do so I can get a yes answer that you're looking at to these three instances.
Let me be precise. We as an agency look into things that are brought to our attention on many matters, but we are not allowed in this setting or in other settings to talk about to say that we are investigating or not investigating. That's something that protects the public as well. But I want to say, generally speaking, whether somebody's in the government or outside of the government, that one is not to trade on material non-public information. And that's what our laws are about. And we pursue those. We've pursued them in the past when there have been members of the administrative or official sector, as well as even occasionally state and local actors in the official sector.
Okay, well, let me ask you in a different way. So would prohibiting government officials like members of Congress, the president, members of the board of governors from holding or trading, individual stocks limit conflict of interest and potential inside trading?
I think that as a policy matter, Congress took up, at least members of Congress, in an act 8 or 10 years ago, if I remember. But taking it up more broadly could help instill greater confidence in this. I mean, we're going to do what we do at the SEC and do it well with regard to holding people to our laws, as you would want. But Congress could say to do even more. There's public transparency that Congress has already put in place, public transparency that those of us in the official sector have to file various transactions.
Time they file, we find out there was some conflicts or, some obviously, that's the thing. And Chairman Gensler, I want transparency in people filing. I'm always about complying with that. But then what happens afterwards? We don't find out that they were held accountable, and then it continues and really taints our process to the point where people won't trust us anymore. And Chairwoman knows how incredibly passionate I am about this. But I don't think we should be allowing public officials, trading stock, period. And if you're going to be put in this position, that is a sacrifice you're going to have to make, because it is about the public's trust. And so I just appreciate you I hope it's relayed, but I do appreciate you coming before the committee. But I hope you do go back to your team and let them know this member from Michigan is very concerned and hopes that you are investigating these 3 instances. Thank you. I yield.
Very much. Thank you very much. The gentlewoman from Texas, Ms. Garcia, who is also the vice chair of the subcommittee on diversity and inclusion, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Gensler, for being here with us today. And the end is in sight. The end is in sight. Thank you for your patience and your perseverance with us today. I appreciate the great work you've done so far in leading the SEC back in the direction of strong investor protection. The issues presented by crypto assets and stablecoins are far-ranging, and while these discussions are evolving continually, and much discussion today, of course, I wanted to get some insight on how you and your colleagues at the SEC are framing the discussion. As of yesterday, the block reported that the total stablecoin market is estimated to be worth $127 billion. I think you mentioned that. Compare this with between 2017 and 2019, when the stablecoin market grew from 10 million to 5 billion. So it has skyrocketed, as you noted, in the last couple of years. Despite the intricacies of stablecoins and their proposed merits, it's absolutely imperative that we recognize the systemic significance of this to the market. Chairman Gensler, in your August 5th letter to Senator Elizabeth Warren, you stated, quote, "In my view, the legislative priority should be center on crypto trading, lending, and DeFi platforms. Regulators would benefit from additional plenary authority to write rules for and attach guardrails to crypto trading and lending." Could you discuss a couple of examples of legislative measures you have in mind for protecting the financial sovereignty of our market, specifically as it pertains to stablecoins?
As it pertains to stablecoins, I think that they have provided an alternative way to trade on these trading platforms, and they're intertwined inside of crypto trading around the globe. They initially came along around 8 years ago, frankly, so that not only to be efficient, but also to avoid some of the overseas, some of the anti-money laundering protections that were around the globe when these trading platforms were unable to get bank accounts at various banks around the globe. I think they've evolved now to be at the center of the trading and lending platforms, and that it would be really helpful to work with Congress around these. Again, at one end of the spectrum, it might just be something digital around the digital dollar. Remember, we already have a digital dollar. It would be sort of misleading to say we don't. But this is something, an additional digital wrapper around the digital dollar. And the question is, what does it provide, and how do we protect the public still for tax compliance, anti-money laundering, and financial stability? At the other end, they start to look like money market funds, and how do we, the SEC, protect the public for investor protection and the like? So I think that there's a range of these different coins, and even if they're all the way over on one end, we have to protect the public in terms of these guarding against illicit activity tax and financial stability. And lastly, I do think that the platforms, the lending platforms, the crypto trading platforms, where there's 5,000-6,000 other cryptocurrencies, non-stable coins, so to speak, are highly volatile, speculative, usually investment vehicles. We need to get our arms around that.
Thank you. And I want to shift gears a little bit too. I think you characterized it as human capital in your written remarks. And this committee has been advocating for the creation of Office of Minority and Women Inclusion across all financial regulators. In 2018, the SEC asked almost 1,500 of those entities regulated by the SEC to complete a voluntary diversity assessment. Only 5% responded to the request and submitted data. What are you in the OMWI office doing to increase participation? Have you considered making these assessments yearly and mandatory, or using some other inducement to encourage greater participation in these assessments?
Well, I thank you for flagging that, and I do think that we could do better than the 5%, but what we'd have to sort of encourage and, as I would say, make it easier to participate. Separate from that, because that initiative is really important, but separate from that, we are also looking at investor demand to know more about the workforces of American companies or listed companies. This includes many overseas companies as well as listed here. And in those disclosures, that I've asked staff to consider whether we should also have this disclosure of the forms that are shared with the Department of Labor, the EEO-1 diversity disclosure forms.
I'm familiar with that. I've worked at the EEOC before. But would you consider doing them yearly rather than every other year?
Could we, I'd like that suggestion. Could I get back to you and work with staff and see, because they volunteer, as you know.
Thank you very much. The gentle lady's time has expired.
Madam Chair, he froze there for a minute. I didn't get his response clearly.
Yes, you're way over time.
All right, thank you.
Follow up. Would you please follow up?
Yes, ma'am, I will. I yield back. Apologize.
Thank you. The gentleman from Texas, Mr. Taylor, is now recognized for 5 minutes.
Thank you, Madam Chair. Can you hear and see me?
I can see you and I can see the Texas flag.
All right. Thank you, Chairman. I appreciate this hearing opportunity for us to discuss important issues. And I had wanted to talk about crypto, but I think that that's been very well covered by my colleagues. So I'll skip ahead. In your opening remarks, you talked about the use of AI and machine learning in the markets. Did I hear you that you're using it at the Securities and Exchange Commission presently?
We really have a good data analytics group, but I would say our use of machine learning is limited compared to the capital markets, which are really using them increasingly to even follow a hearing like this. Everything that we're saying could be followed by artificial intelligence for sentiment analysis, and depending upon how you or I speak, could be fed into the computers and to see whether markets move up or markets move down. But we have a very limited at this stage in 2021. I hope to do better in the future.
Are you using AI machine learning in your stock watch, in your anti-insider trading efforts?
We're using data analytics, which I'd rather not discuss in public, the data analytics we use, but I would say that we're really at this stage, frankly, behind the capital market participants, the high frequency trading shops, the big asset managers, and their use of sophisticated data analytics like machine learning.
No, and I mean, and the reason I asked this is that, I was actually in New York yesterday. I'm unfortunately back in Texas today, but, meeting with Bloomberg, and, they have a, incredible data analytics operation in the valuation of bonds, and they're doing that as a market service, right? So they sell their service in terms of valuing bonds. And they have 150 people working around the clock, trying to value bonds, and they're tweaking a machine, AI, to figure out what is the proper value for a bond. And it seems to me that there are some applications for AI within the federal government, and I think the Securities and Exchange Commission comes to mind. Have you given thought to where you think that you could expand the efficiency of your operation at the Securities and Exchange Commission, whether it's at Stockwatch? I kind of know that's what comes to my mind is the anti-insider trading operation, where you're trying to track, a tremendous.
I think that there's multiple places, and I'm sort of a finance person, a markets person, but I had this opportunity to be at MIT for a few years and really study this more up closely. I think we could use it not only in market surveillance, which is actually what you're talking about, market surveillance, but also throughout our examination and potentially enforcement, where we can look at troves of data to look at patterns. What machine learning, what artificial intelligence is so good at is extracting patterns from data and finding those patterns in market surveillance or in other examination. And right now, many, Bloomberg, as you mentioned, but many market participants are using it to basically maximize their returns. I think we have a second thing at the SEC that we're looking at is how are platforms using it to engage with the public, and are they optimizing their revenues based upon the data of my whether it's my social media or elsewhere, but are they optimizing for their revenues? If they're optimizing for our engagement, that can be a positive, but it also can raise some conflicts if they're maximizing for their revenues rather than for the public's investment returns.
Sure, Chairman. I look forward to working with you to identify areas where you can modernize the SEC, use AI and artificial intelligence, machine learning to find better ways to do your job. I mean, whether it's high frequency trading, finding irregularities within markets. I think that's an important opportunity and as you have so amply pointed out during this hearing, we enjoy the greatest capital markets in the world. And I think having a sophisticated SEC that is prepared to do its job and make sure that they have advanced tools to go do that only makes sense. So with that, Madam Chair, I yield back.
Thank you very much. The gentleman from Massachusetts, Mr. Auchincloss, is also the vice chair of the full committee. Is now recognized for 5 minutes.
Thank you, Chairwoman. And Chair Gensler, I appreciate your thoughtful answers and your persistence today. Almost done, almost done. You've been very clear in your written and in your verbal testimony that you want to bring crypto into the basic bargain, as you describe it, where investors get to make their own decisions about how much risk they take on, and companies have to report consistent and decision useful information. You want to bring crypto into that bargain. You've also been clear that you think most of the major crypto players have at least some elements of their businesses that are securities and should operate on that default assumption, and that you'd like each of these crypto actors to be coming to speak with the SEC on a one-on-one basis to get feedback from you, and also I think from what you've said, to give you feedback on what kind of regulations make sense. I think everything that you've outlined sounds like a reasonable way to approach a nascent, promising industry. I think we're reaching a tipping point, though, where we need more stable, broad-based law that does not require a phone call with the chairman of the SEC, but that a startup with their counsel can understand the risks that they're getting into from a regulatory perspective. And so for that end, we need Congress to act. My question to you first is, would it be most helpful for Congress to create and delineate a new class of security that had a separate regulatory apparatus, or would it be most useful for Congress to divide explicitly crypto assets between the CFTC and the SEC?
I think actually the laws are pretty clear that with regard to these, and that those entrepreneurs and their lawyers could look, and they don't even have to squint. They can look. The Supreme Court has really said what is an investment contract. In terms of your question, I think that between the CFTC and SEC, we have good authorities. Chair Benham and I have been talking a lot about how we can coordinate better. I don't think there's a need to, set something new up, but I do think that if something is a security, people have raised, well, but can we follow everything that was written for traditional bonds and stocks? And so we want to hear that. We want to think about that. And Congress would probably want to think about that as well. I would say a cautionary note, if Congress were to carve something out of the securities law, could also undermine 90 years of economic success and undermine the 7,000 plus issuers now who would say, well, wait a minute, there's regulatory arbitrage. Somebody else is raising money in the capital markets, operating like a security, but they have a different regime.
So I hear that, but then I guess I would come back to you, because I've been listening this whole hearing, and I haven't really heard an ask from you about what Congress can do to make your job easier as it comes to regulating crypto. I think you and I are in agreement that we need to be regulating crypto. I agree with you just intuitively that a new regulatory agency doesn't sound like it makes a whole lot of sense. I believe you that a lot of the law is settled if entrepreneurs and counselors and their counselors would examine it in good faith. But there clearly is gray area, and business and especially investors don't like uncertainty. They deserve some certainty. So how can we help you?
So let me raise two areas I think of. One is with regard to stable coins, the stable coins that are all the way over this end, that are really just investing in cash, not operating more like a money market fund. I know, and I let them speak for themselves, but my colleagues, the bank regulators, think there's more that we can do with Congress's help on that end of the spectrum with terms of stable coins. Even the ones that are all the way over and operating more like money funds has to be taken into consideration. I think in terms of working with the CFTC and the SEC, we have robust authorities over exchanges, over somebody that's trading securities on their platforms. The CFTC does not. They're a derivatives regulator, but they have enforcement authorities over commodities. And so what happens when we have a platform that has a few commodities, but mostly securities on it, and the coordination between the two of us and that oversight and also authorities in that regard. So, I mean, there's many, I would say, secondary and third level issues as well.
I appreciate that. And just a final point before I run out of time. We've heard some colleagues on the Republican side of the aisle talk about ESG investing, and they're worried that it's getting politicized. I think one of them mentioned a debate about climate change. I would just say for the record, I mean, there's a debate about climate change to the extent that there's a debate about evolution by natural selection. You can debate it, but the science is clear. And I think what your agency is doing by making ESG more transparent and market actionable is important and should be continued. Chairwoman, I'd like to yield back my time, and I would like to request unanimous consent to include into the hearing record a letter from the Investment Advisors Association and the National Association of Personal Financial Planners.
Without objection, such is the order. Thank you very much. Are there any members on the platform who were not recognized because of their absence early on and they've returned now? If not, I'd like to thank our distinguished witness for his testimony today. Without objection, letters from the North American Securities Administrators Association, the Council of Institutional Investors, the California Public Employees Retirement System, and the Consumer Federation of America will all be included in the record. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for his response. So I ask Chair Gensler to please respond as promptly as you're able. I'd also like to thank Chair Gensler for the time that he's given to us today and for the way that he has shared information that has been so important to all of our members. So without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I thank you all so very much, and this committee is adjourned. Thank you.